Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Ngwiri, and today, ladies and gentlemen, we are discussing about the business data analytics, December 2023, question 22. It reads as follows: Safari Limited is evaluating a project with the following details. You've been given the initial investment, 100 million, residual value, 10 million, year one projected project cash flows is 25 million, the annual cash flow growth rate from year 2 is 10 million, the project life is 5 years. You are required: A, compute the following project metrics: payback period, number 1, number 2, the net present value, assume a discount rate of 12%, number 3, the profitability index, assume a discount rate of 12%. B, using a graph, determine the project's internal rate of return, and this totals 30 marks. So trying to answer this question gives us or gives you 30 marks there in total. So to start us off, we are first of all going to do the following. We're just going to first of all come right here and we say we have the year given to us over here. And this solution over here, you can just drag this one down over here. This is A, and this gives us year. So we have the years given to us. They're from year 0, 1, 2, and of course you know what happens. Once you put it like this and then you have that plus sign like that, you can drag it up to the number of years you actually want, like that. So let's assume it goes all the way to year 5. Not assume, we've been told it goes to actually to year 5, and you can be able to see the project life right over here is 5 years. So from year 0. And we are saying from there, then we need then to put the value over here. We're dealing with Kenya shillings, so shillings, put shillings, and we are saying we can put them in thousands. That all of these need to be put in terms of thousands over here. That why? Because we're dealing with thousands. We just do not want to deal with very big figures like that. We just want to deal at least with manageable figures. And from there, we can put over here the initial investment. That. Then we can put the initial investment right here as 100,000. Why am I putting 100,000? Guys, because you're saying that we are expressing it in terms of thousands over here. Yes, it's 100 million, but if you remove those 3 zeros there, we're saying we're dealing with 100,000. And because we want to deal with values that are in terms of the accounting format, so let's put it like that, then just do it sort of something like that. That looks at least well presentable, I mean. So initial investment is that. Then we have the residue value or residual value. That. And the residual value is assuming that you sell the asset at the end of the project or after 5 years there. So right here I can put over here in terms of the residue value, you can put 10,000 here. You sell an asset and you realize 10,000 in terms of value. Once that happens, then we can move ahead and look at the values over here in terms of the net cash flows over here, the cash flows. And you're saying the cash flows over here, we've been given the initial investment is 100 million. You're saying the project 1 cash flows is 25 million over here. So assuming that this is, of course, is the initial investment, we can put a negative value over here like this. We're saying that we can be able to put, so it's negative, I just sort of put negative, enter, it can be able to appear, and that it's an outflow. We can put the values over here as follows. For year 1, we are saying is 25,000. Not right there, you can put, because this is the residual value, the cash flows here, 25,000. That, and we are saying this 25 million or 25,000 over here, in our case here, is going to grow at an annual rate of 10% from year 2. So from here, we can do sort of something like so. We add that value and multiply it by a factor of 10%. So times 1.1. That. We get 27,500. Then we just drag it, because this has got a formula. We drag it sort of like that. And we make sure at least it auto fits within the cells. So from there, we are saying that what is going to be our net cash flows? Our net cash flows are going to be as follows. Flows. Then, so here we're going to pick this value here. The ones we're going to discount, these ones are going to use this value here. And then we are saying we're going to use, just going to pick the residual value plus the cash flow itself over here, if any. So that now it, after period 5, we expect this cash flow to be 46,603 over here to be the cash flow you're going to discount back to period 0. So we drag it and it picks. You can see now these are the cash flows which you're going to discount over here. You can put them in bold, Control B. That, of course, we can be able to expand it by sort of clicking, double clicking like that. Those are the cash flows. Once we have that, we can then get the payback period. So over here, I can write now the payback period. Because that's what you're looking for, payback period. This means that we need to get the cumulative. Cumulative values. I can be able to just put it sort of like that, and we come right here and put it maybe in form of a box like that. So that's what you're interested in, the cumulative cash flows. So here it's just going to be that value, and then we are going to pick plus that value plus this net cash flow here, comes to 75, and then we reduce it. We continue, we drag it because it has got a formula. We continue up to there. But if we continue over here, if we get 33,000, we subtract, because of or 17,000, we subtract 33,000, we should be able to get a positive value. What the payback period tries to measure is how much you can be able to recoup this original investment of ours over here of 100,000. So clearly over here we'll be able to get a positive cash flow, yes. But in terms of the payback period, in terms of years, you can see the number of years given to us right here. We can say that the payback period, so payback period over here will be given to us right over here. So this is year 1. We can say year 1, indeed, we're still getting a negative cash flow. Here, year 2, we're still getting a negative cash flow. Year 3, we're still getting a negative cash flow over here. But when we reach year 4, we are going to get a positive cash flow. This, let me just demonstrate. We're just going to get a positive cash flow over here like so. And that's not what we want. We want to recoup this original investment. We do not want a positive cash flow. We want to see the exact number of years we're able to recoup this 100,000 right here. So just delete that. We know it is going to be 3 years, but 3 years and how many months? So we can be able to put the number of months right over here, or we can be able to compute it right here. So it's going to be that value over this value, and then we multiply by 12 because we want it in terms of months. Like that. So 6.22 months. So the payback period you can see is, we can say, is here. Payback period is 3 years, 6.22 months. That is what answers our first part right here, the payback period. So we can move ahead to part B, the question over here. And part B, we can just go down right here. B. It's a similar fashion or a similar format. We are looking for the net present value right here at a discount rate of 12%. So net present value. Net present value. And we're saying the net present value is, just given, is just how much we are able to get. Are we going to realize a positive cash flow or a negative cash flow based on discounting? You're using a discounted cash flow technique so that you can be able to get the present values. And in a similar way over here, so we're not in B, we're doing part A part 1. So this is A part 1. I can just put it like so. This is A part 2. A part 2, like that, so that now we can be consistent there. And to get the net present value, what we'll need to do, if you allow me to copy this over here like this, cash flow, the cash flows over here, I can be able just to copy these ones, the way they are like that, copy, just put them just down here. So, and of course, I'll be able to also copy this. Allow me to copy this. Copy. Put it just down here like so. And this I can drag it maybe down. I can just drag it somewhere down there like that. So the initial investment, we pick it from above here. That's the initial investment there. No problem. The residual value, we just pick this from above here. And then we're saying the cash flows, we're just going to pick whatever we have right above here. So we're linking it like that. And we're saying these cash flows are the ones which we will need then to discount. So this is how we're going to discount it. So the net cash flows, we still pick them from above there. Net cash flows, like that. And then we have this value like that. And this is what you're going to discount. These ones over here. These net cash flows. You see, like the way I've did over here, the relevant values, these are the ones which are going to, we're going to discount and get the present values right over here. So present values. So the present values will be, we're going to get this value over 1 plus R over here. But for us to be able to get the present values, or in Excel, there's always a way we can be able to get the present values, always. There's always a way how we can be able to do it. And we can just say the NPV. Instead of discounting this value over 1 plus the discount rate power 1, this value over 1 plus the discount rate power 2, power 3, power 4, and power 5, like that, we can just go to the to a formula NPV, like that. And we are saying, we open it up right here, and we can see the rate. The rate is just 12%. And once we have the rate as 12%, under the value 1 here, we put in those cumulative cash flows like that. And then we will need then to subtract the initial cash outlay. So would it be correct for me to add right over here? We add the initial cash outlay there, like that. That's the initial cash outlay. So that's what we are saying we are going to have. 13 million, of course, because we're dealing with millions, 13,365,099. That is what you're saying represents NPV. And so you can maybe highlight the answers maybe in red like that, so that you can be able to know that these are the answers. We can move on and discuss about the profitability index. The NPV, before we move on to the profitability index, the NPV is the net of present values to try and see whether you're able to get a positive cash flow or a positive value or a negative value. If NPV is positive like this, we accept the project because the project is going to yield us positive values in future. But if you get a negative NPV, then it doesn't make any sense to us here. So here, part 3, I can move ahead right down here and now click this one to be 3, the third one. That. A, part 3. We talk about profitability index. That. Under profitability index, we are going to get the present value of cash flows divided by the initial cash outlay. That gives us the profitability index. Any number greater than 1 gives us positive, or we are supposed to go ahead and invest in that project. If it gives us anything less than 1, then we reject the project. And we are told to assume the discount rate of 12%. So what we do is that we just go ahead and use similar values right over here. Copy. We come right here, or rather I should have copied from here, sorry. Copy, and you put it right maybe just down here. Paste special, we want to paste special formulas and all. Oh, it's refusing, so we just look for an alternative way, put it like that. So with these values, we can just link it with the first value right over here. So just link it with that one, that, and we can just drag it moving across like that. The residual value picks from here. That. So these represent the net cash flows. So this is what we're seeing is shillings. So just delete this and it's okay. But the initial investment picks from here. The net cash flows. That value there. So once we have that, then we can be able to get the profitability index. And the profitability index, we are going to get the present value of cash flows divided by the initial divided by the initial cash outlay. So we're going to use NPV rate 12%. The values, we are saying we're going to use these values here. And there's one thing that we needed to change here. We need to add the two values, these two values here, before we continue. That one plus that one there. See the profitability index, NPV. See here, double click it. Then we open it up right here. And you see the rate is 12%. And then with 12%, we can put in the values over here like that. We are getting that value, the present value of cash flows, and we are going to divide this against the initial cash outlay. So minus, open the brackets, this one. Enter. That's what we get as our profitability index, 1.13. So in this case, we accept this one based on NPV, we accept, and the payback period, if it's the shorter the payback period, the better it is for us. So here, just like for consistency purposes, we put it in red like that. And we can see that we're moving on well, and we now move on to part B of the question. Using a graph, determine the project's internal rate of return. The project's internal rate of return is at the point where you get, the NPV is equals to 0. Where the NPV is equals to 0 is where we are saying our project's IRR is going to be. And so we're going to use a graph. So first of all, you're going to test it using the IRR formula. So IRR, or internal rate of return. Rate of return. The internal rate of return, IRR, is going to be, we open it up right over here, the values. So we put the values right over here, all of the values, including the negative value here. And we say, okay. So it's around 17%. And that's what we expect, or 16.75%. That's what we expect from using the graph, around there about. So he picks arbitrary rates, so 12%. You can put 12% over here, 13%, like that, and so on and so forth like that. So we just drag it. So we can just get arbitrary rates over here, and we get the corresponding NPVs. So NPV over here, 12%. The rate is 12%. You can see from right over here, 12%. The values over here are these ones here, the net cash flows here, like that. And then we do what? We add the initial cash outlay. The initial cash outlay in this case was negative here, that, and we get that value. So it's the same as what we got above over here. That's fine. But because we want to ensure that we want to get the corresponding NPVs at different rates over here, I need to lock the formulas over here. So I press F4 there, I click over here, I press F4, and I press F4 over here, so that I can be able to lock and ensure that everything is okay. So if I drag my formula over here, it should be able to work. So that's what I'm going to do right here. So shift, Control D. But it's picking 13%, or it's because I didn't change. You see, it's still at 12% here. So what I'll do, I'll just change this to 13%, 14%, like that, 14%, 15%, and so on and so forth. Just come and change here, 16%, 17, that, then 18, So don't worry about that. 19. Then here we got 20%. 20%. Like that. So you plot a graph over here. This is the NPV. NPV, that rate. Like that. So just sort of put it center to make it look presentable, and like that. Then you can just draw a graph here. Insert. Then you come to recommended charts, and you can be able to see, based on this graph over here, that point, okay, just place it somewhere right here, that at around 16% over here, you can see at around this point here, if you click right here, it will give you the point. At around 17% is when you're going to get negative NPV thereabout. 17%. And you can see it's 16.75 right here. So the exact rate should actually be somewhere over here where it's next to. It's along just this curve over here. It cuts it along this axis over here like that. NPV indeed is at 16.75. So once you draw the graph like this, it should be able to, and then you just highlight like this, you can be able to see thereabouts around approximately 17%. You can be able to get the IRR. So ladies and gentlemen, this brings us to the end of the class. We have done question 22 of the business and data analytics paper, which came in December 2023. Hope you have enjoyed it. God bless you all. Bye bye.
How are you over there? My name is Patrick Kamau Kamure. You are lecturer in taxation. Welcome to today's lesson of public finance and taxation, where we continue looking at the taxation of the business income, where, if I can give you a little of recap of what we did, is that we said that there are three businesses that we need to see how they are taxed. One of them is the partnership, is the sole proprietorship. The other one is the partnership, and the third one is the limited company. In our previous lesson, we did the taxation of the sole proprietorship. So for today, we want to go to the next business, which is the taxation of the partnership. So partnership is where we have two or more people who come together to do business together, and they don't register their business as a company. Because of that, we normally say that partnership do not have a separate legal entity from the owners, and that will mean that when you are taxing the partnership, you tax the partners themselves, not the partnership itself, because it is not separate from the partners. They are partners, and the business, they are one and the same thing. So now we want to see, how do we normally tax the partnership business? First of all, I want to write over there the introduction or definition of the partnership as I've illustrated. So we have partnership is a business owned by two or more people which is not registered as a company, and so does not have a separate legal entity. That is the definition of the partnership. But our objective or goal is to know how we usually tax the the partnership business. So these are the items that you need to consider when you are taxing the partnership business. So areas to consider, or items to consider: while taxing partnership business. Number one, determination of taxable income. Determination of taxable income, and say this is done using either or A, gross profit method, or number two, or B, net profit method. What we are saying is that when you are determining the taxable income of the partnership, just like other business, and as we introduced earlier on when you are introducing to the taxation of the business today, any business, when you are determining the taxable income, you either use the gross profit method or net profit method. So the same criteria apply to the taxation of the partnership. You either use the gross profit method or net profit method to get the taxable income. We have Roman 2. Another items that you need to consider when you are determining taxable income of the partnership or taxing the partnership is the following expenses: are not allowable in partnership. I.e., salary to the partner, to partners, interest on capital, interests on capital from partners, to the partners, commission and bonuses to partners, drawings by partners, and any private expense of the partners. That is the second thing that you need to know, that those expenses, when they are incurred by the partnership, they are considered to be non-allowable expenses. Salary to the partners, interest on capital, bonuses, the commission, the drawings. In short, we are saying any expense relating to the partner, like private expenses of the partner, we don't allow them when you're determining the taxable income. The third one that you need to consider, the following incomes: are non-taxable incomes in partnership, i.e., what are those incomes that are not taxable? Interest on drawings, profit on goods sold to partners, and any other income other income from partners. That's another thing, that when you're determining the taxable income of the partnership, if there's any income that the partnership received from the partners, we treat it as non-taxable. This you hear like interest on drawings, like when the partner withdraw anything from the partnership, like goods, the cash, they charge interest. That is an income to the partnership, but it is usually not taxable. Another thing is like sometimes they can have a provision, or the partners can have a provision that if a person wants to buy goods from the business, can buy and they are going to be charged a profit like any other customer. So that profit is not taxable in the partnership, and any other income that the partnership may get from the partners. The fourth one is the income distribution schedule. Distribution schedule. What does that mean? Once taxable income of partnership is determined, it is distributed to partners using income distribution schedule where they bear individual tax burden. They are taxed individually at graduated scale rates in the same way as employment income. After the distribution. The gross tax once determined, then set-offs such as personal relief, insurance relief, and withholding tax on investment incomes are deducted. Income distribution schedule has the following format. So what we are saying is that about the income distribution schedule, once the taxable income of the partnership is determined, either using the gross profit or the net profit, we tax the income on the partners themselves, and we tax them at graduated scale rates. Graduated scale rates is the same as the employment income, the way we taxed the sole proprietorship, where once you distribute to the partners, because the partners are the one who bear the tax burden, you tax them individually. It is partner A, how much is the taxable income, tax individually at graduated scales. Partner B, how much is the taxable income, tax them individually. And then once you get the gross tax of each partner, you less the set-off. Set-off, we said that they reduce the actual tax they are supposed to pay, and they are like personal relief, the withholding tax on investment income, and insurance relief if they have life insurance cover, education insurance cover, or NHIF. Now, I want to show you how the distribution is done through the income distribution schedule or allocation schedule. So it has this format: income distribution, stock allocation schedule. We start by distributing the taxable operating income, and then we list the partners. Partner A, we are assuming partners are A, B, and then we have a column for the totals: shillings, shillings, shillings. So the taxable operating income you would have determined using either gross profit method or net profit method. You can distribute it this way. The first one is usually the salary. So salary to partners. If partners have the salaries, if this one had a salary, you put there this one and the total. The next one is interest on capital. Interests on capital. So interest on capital for this partner, for this one, and this, if there is any. Then commission or bonus. You put on this, this, and this. After that, those three are the one that you usually post. If there is commission or bonus, interest on capital, salaries to the partners. Then you less interest on drawings. Interest on drawings. So interest on drawings here, you less if anybody withdrew the goods and they were charged interest there. Now, after you have distributed those one, the taxable operating income you'd have determined, you minus what you have distributed, minus this, minus this, minus this, but this one you add. Then whatever remains you share according to the profit sharing ratio. We call it profit share. Shared according to profit sharing ratio. So you come, how much is this? This total. And then after that, get the total taxable operating income. Total taxable operating incomes means we take the salary, the interest on capital, if there is commission or bonus, less interest on drawings, profit share, you get the total here. You do the same for this, you do the same for that. Now, you have just distributed the operating income. Then you add taxable investment income. Taxable investment incomes shared according to profit sharing ratio. Sharing ratio. So if you have something like rent, non-qualifying dividend, non-qualifying interest, royalty, all those, remember, withholding tax is not final. You come and share here according to the profit sharing ratio. This one, total. And then now from there, you can get total taxable income. Total taxable incomes, which will take the operating income plus investment to get the total. Operating plus investment, operating plus investment there. And now, if you're asked about now taxing, getting the tax payable by partners, you will tax this one A individually on this using the graduated scales, the way we tax a sole proprietor's income. The same case, this one, a B, tax on this one to get the tax they are supposed to pay. So that is what you need to know when you are taxing the partnership business. And from there now, I want us to look at a question. So I read the question, then I'll show you how it is solved or computed. This is what the question says. Hi there, my name is Patrick Kamau. Welcome to today's lesson of Public Finance and Taxation, where we look at the taxation of farming activities. So farming activity is somehow connected to the taxation of the business that in our previous lessons we have covered, because all matters is how is the farming activity carried out. Is it done by a limited company, a partnership, or a sole proprietorship? So when it comes to the taxation, determination of the taxable income, everything remains the same. So the only difference are just two things that you need to know. Additional taxable income in farming. Those are incomes that are specifically for farming, in addition to the one that we said are taxable under normal business, and also additional allowable expense. The one that we talked about are still applicable, and now they are those specific in farming because farming is a special activity. So I want to write something about the taxation of the farming activity here. Before then, at the end of it, we look at a question. This is what you need to know, that farming is also called agriculture. And it involves keeping of animals or growing of crops for food or commercial purpose. When farming is done for commercial purpose, then the income generated become a taxable income. Another point is farming is taxed depending on how it is carried out, either in partnership, by a limited company, or by a sole proprietor, where it is taxed in the same way as these businesses as already covered. However, the following apply specifically in farming. So we have number one, the following specifically apply in farming. We have additional taxable income. This includes all incomes generated in farming, i.e., income from selling of crops, livestock, farm produce, animal produce, etc. Before we continue, what we are saying is that, as I had introduced, that you do farming either for food, for commercial. If you do farming for commercial purpose, then the income you generate become taxable profit like any other business. Now, how do you tax the farming activity? It depends on how it is being carried out. Is it being done by in partnership? You tax it in the normal way, like a partnership, the way we have covered in our previous lesson. Determine the taxable income, then distribute the income to the partners, then tax them individually. Is it done by a limited company? It is a company, determine the taxable income of the company, then tax the company, just normally. Is it done by a sole proprietor, where you determine the taxable income of that sole proprietor, then tax him? However, we are saying the following specifically apply in farming: additional taxable income. Like that, any income that come out of farming activity, like selling of crops, livestock, animal produce. Animal produce are like eggs, milk, hide for the animals. All those are supposed to be taxable, and any other income that come out of farming activity. Then we have number two, additional allowable expenses. Additional allowable expenses. This include, we have A, costs of purchasing seed, fertilizer, and livestock. B, we have farm operation expenses. Such as cost of water, electricity, transport, etc. Then we have C, costs of clearing land and planting permanent and semi-permanent crops. D, costs incurred to prevent soil erosion. I.e., construction of gabions, terraces, and making of windbreaks. The last one, capital allowance. Capital allowance on capital expenditure farm work costs. This one, check capital allowance, computation. So what we are saying is this: when you see these expenses and they are incurred in farming, treat them as a allowable expense. One we are saying is the cost of purchasing seeds, fertilizer, and livestock. In farming, they are allowable. Treat them as allowable expense. Farm operational expense, just like any other business, water expense, electricity, transport, and any other expense incurred in farming, allowable. Cost of clearing land and planting permanent and semi-permanent crops. Permanent crops are the crops that can be in the farm in the long term, like coffee plants, tea plants. The cost of planting them are allowable. Semi-permanent are like pyrethrum. They're usually in the short run, but 2, 3, 4, 5 years. They are all allowable. Cost incurred to prevent soil erosion, like construction of gabions, terraces, making of the windbreaks. All these are allowable as long as they are to prevent soil erosion. And capital allowance on capital expenditure in farming. Capital expenditure in farming is also called farm work cost. So when you see farm work cost, claim capital allowance under farming. And this I'm reminding you to go and check the capital allowance computation because we learned about it. Now at this moment, I'd like us to look at a question to see what we are talking about. So I read the question. This is what the question says. Mazao Ranch Limited practices mixed farming and milk processing. The following is the company's statement of profit or loss for the year ending that 1st December 2020. We have the revenues consisting of sale of milk, sale of livestock, sale of manure, proceed from the sale of an old tractor, discount received, expenses, which we have general expenses, construction of water tank, vaccine for livestock, loan repayment, depreciation, electricity and water, conveyance fee, construction of chicken sheds, animal feeds, salaries and wages, bad debt provision, repair and maintenance, professional fee, net profit. Additional information number 1, farm work acquired on 1st July 2020 comprised of the following: granary, labor quarters, cow sheds. Number 2, general expenses include subscription to a farmers association, acquisition of a 50-year lease, staff Christmas party, parking fine. Then number 3, repair and maintenance comprised, provision for fencing expenditure, repair to machinery, other repairs. Number 4, professional fee include 500,000 paid with regard to pursuing a dispute with the Kenya Revenue Authority, VAT department. Then assume corporate tax rate during the year was 25%. Required adjusted taxable profit or loss for Mazao Ranch Limited for the year ending that 1st December 2020 and the tax payable if there is any. So in this case, we take note. Yes, it's a farming activity, although they are mixing it with processing, but the key thing is farming activity. And then the farming is done by a limited company. So whatever we have been saying about a limited company apply with addition of this additional taxable income we have talked about and additional allowable expense. So we treat it as a normal, it's a company actually. So the next question should be, which method are we supposed to use to get the taxable income? Like any other business, for this one we use the net profit method because we have been given the net accounting profit after the income statement. So this is how we go about it. For the year ended 31st of December 2020. So we start with net profit provided, which we have 157,000. Then when you are using the net profit method, we said you add non-allowable expenses in P&L and taxable operating income not in P&L. So just like we have been using the net profit method, we'll go through the P&L, look for the expenses that are not allowable in the P&L first. So which expenses are in the P&L? General expense. General expense we have been saying is allowable is for the business. Construction of water tank, we don't allow. Water tank, that's a fixed asset. So construction of water tank, a fixed asset, we don't allow. Of which case we have 240. Had been deducted, isn't allowable. Next, vaccine for the livestock. That is a allowable expense, vaccine, because it's a farm operational expense. Loan repayment. We said loan repayment is not allowed. What we allow is the interest on loan, not the loan. So we disallow that. Loan repayment, 350,000. After that, depreciation. Depreciation isn't allowable, so we add it. Depreciation, which you have 180,000. Electricity and water, that is allowable expense. Conveyance fee, no. If you go to the legal expense, we said conveyance fee is not allowable. And which we have 156,000. Then construction of chicken sheds, that's also a fixed asset, you know, a structure. We disallow. Chicken sheds, a fixed asset for 80,000. Animal feeds, that is an allowable expense. We said an operational expense. Salaries and wages is allowable. Bad debt provision. Provision we don't allow unless they are specific provision. So we disallow that. Bad debt provision, which we have 150,000. 150,000. Repair and maintenance, that is allowable, and also professional fee are allowed. From there, we go to the additional information we look for, an income not in P&L. If an income is not in the P&L, can only be in the additional information. And if it happens to be taxable operating, we add. And at the same time we go there, we look if there is an analysis of the expense in P&L. In the analysis, if they do happen to be non-allowable, we add still. We start with the additional information, number 1. Farm work acquired on 1st July 2020 complies of the following. Now, farm work, that's a fixed asset. We said here, it's a capital expenditure. We don't allow capital expenditure. We claim capital allowance. But those expenses, if you look at them keenly, they are not in the P&L, so we cannot touch them. Then number 2, general expense include. Now, general expense is one of the expenses in the P&L, so we look for the non-allowable expense in it because it's an expense in the P&L. Subscription to Farmers Association, that's a trade association which we allow. Acquisition of a 50-year lease, that's allowable. We said up to 100 years, up to 99-year lease is allowed. Staff Christmas party allowed for welfare. Parking fine, we don't allow fine. So in this case, we disallow. Which we have 129,000. Then after that, we go to number 3. Repair and maintenance complies. Now, repair and maintenance is in the P&L. So we look for the non-allowable in it. Provision for fencing expenditure. We don't allow provisions. So we add provision. Only specific provision for bad debt do we allow. This provision for fencing, it's not specific provision for bad debt. For fencing, which we have 145,000. The other one is repair to machinery, that is allowed, together with other repairs. They are all allowable, revenue expenditure. Then we go to number 4, professional fee include. Now, professional fee is in the P&L. If you go to the P&L, the last expense is actually the last one. Is in the P&L. We look for non-allowable in it. It includes 500,000 paid with regard to the pursuing dispute with Revenue Authority VAT. We said any expense relating to tax we don't allow. So we'll have a professional fee for VAT. $500,000. We don't allow. Number 5, assume the corporate tax rate during the year was 25%. That's not an income, it's not an expense. So we are done with an allowable expense in P&L, an income not in P&L. Unfortunately, we didn't come across any. Now we now come to the deduction. Remember, we deduct 3 items: non-taxable operating income in P&L or investment income in P&L and allowable expenses. Allowable expenses not in P&L. So first thing, we go to the P&L. We look for non-taxable operating income there. And also the same P&L, we look for all investment income there. Let's see. In the P&L, these are the incomes. Sale of milk. We said sale of milk is a taxable income. Taxable operating in farming. Income from selling of an animal produce. We said here under taxable operating income. Sale of livestock, a taxable operating for farming. Sale of a manure, that's an animal produce, a taxable income. Proceed from the sale of an old tractor. Under normal circumstances, we don't tax income from selling fixed asset. That's a fixed asset. So profit on sale of tractor, which we have an amount of 820,000. We remove not taxable. The other one is discount received. Discount received is a taxable operating under normal business. That's what we said. So since we are done, there is no other income in P&L that we have not considered. We now look for allowable expense not in P&L. An expense that is allowable that isn't in the P&L. If it is not in the P&L, then it can only be in the additional information. Let's see. Number 1, farm work acquired on 1st July 2020 comprised of the following. Now, farm work that is not in the P&L and it's also not allowed. We said, what do? We claim capital allowance on farm work. Which one? If you go to the capital allowance we discussed earlier on in the previous lessons, so we said granary, that should be 50% without considering time. Even if it was from 1st July, we don't consider time. Labor quotas in farming, remember in farming, is supposed to be 50%. Now, cow shed, that's supposed to be another 50% without considering time. So we claim them. So we are continuing here. On that, we are looking for allowable expense not in P&L. So we have capital allowance. Capital allowance on, we start with granary, which should be 50% of 420. That will be 210,000. Labor quotas, 50% of 1,200. That will be 600,000. Then cow shed, 50% of 160. That will be 80,000. So we are done with number 1. We continue looking for allowable expense not in P&L. Number 2, general expense is in the P&L, including whatever is in there. Substitution, all of them are in the general expense. Repair and maintenance is in the P&L, including whatever is in there. Professional fee is in the P&L. 5 is not an expense. Now that we have not been given capital allowance, and that's the reason why we are computing, you have to come back here and now look for fixed assets so that now you can finish on the capital allowance. We had construction of water tank. That is a structure construction. So that's supposed to be 50%. It is a structure in farming. The other one is construction of chicken sheds. That's another 50%, a structure in farming. And this fencing, if it was not a provision means that they have not yet incurred. They are providing they are going to incur. We don't claim capital allowance. But if it was incurred, we could have claimed 50%. And there isn't any other fixed asset. So you'll come here, a water tank construction of, we have tank, which is supposed to be 50% of 240. That will be 120,000. The other one is chicken shed, construction of chicken shed, which should be another 50%. Chicken shed we had for 80. That will be 240. And since there is no other fixed asset and we are done with the allowable expense not in P&L, we get the net taxable operating incomes. So we are going to take this, add, and then minus. So we start 157,000, and then we add to 40,000. We add 350,000. We add 180. We add 156. We add 480. We add 150. We add 129. We add 145. We add 500. And then we minus the 8, it was 820. We minus 210. We minus 600. We minus 80. We minus 120. And we minus 240, which we have 417. So this is 417,000. Now note, this was a company, limited. So we said company, since it is taxed on its own income, we add the taxable investment income. Investment incomes. But if you look at the question, in the income statement, these were the income. Sale of milk, sale of livestock, manure, proceeds from old tractor, discount. There is no investment income. So this would be a dash, meaning the total taxable income. Total taxable income would be the 417,000. So that mark the end of required one. Adjusted taxable profit or loss of Mazao Ranch Limited for that year. Number 2, tax payable or on profit or loss. So in this case, we say this is a company. We say that, like any other company, corporation tax rate that we have not been told is an unresident or a foreign company, 30%. So we'll say tax would be 30% of 417,000, which will give us how much? 30% of 417. That gives us 125, 100. And that is the end of that question. So that is how you tax the farming activity. And you would have noted that it's not different from the businesses that we have looked at. You just consider it like a normal business. Sole proprietorship if it's done by a sole proprietor. A partnership is if it's done under partnership. A limited company, like the way we have done it there, then you just tax it that way. The only additional thing that you need to know is this additional taxable income and additional allowable expense. So that marks the end of the taxation of the farming activities. And I would want you, below this video, there is an assignment. Kindly go through it, look at it, attempt it, then see if you can be able to do it the way we have done ours here. So for today, we end there. Thank you very much. At this moment, we can look at a question on how to tax a sole proprietor. So here is the question. I'll read and then I'm going to show you how the tax is usually determined. This is what the question says. Lois Rubandi is a sole trader operating as Lloyd Traders. She did not maintain proper accounting records but has provided the following information relating to her income and expenditure for the year ending that 1st December 2015. we have the summary of cash transaction for the year ending that 1st December 2015. We have the receipts, balance brought down, trade receivable, cash sales, commission received, capital. We go to the side of the payments, trade payables, cash purchase, salaries and wages, rates and insurance, medical bill for self, transport, bank charges, general expenses, loan interest, new motor vehicle, drawings. Summary of assets and liability as at January 2015 and that 1st December 2015. We have as at January 2015, as at that 1st December 2015. We have furniture, written down value, motor vehicle written down value, trade payable, inventory, trade receivable, salaries and wages, due, prepaid rates, commission received in advance, capital. Additional information: number 1, discount allowed and discount received during the year amounted to 5,600 and 151,200 respectively. During the year, she took goods for free from the business worth 100,000 for her own use. Depreciation was ascertained as follows: motor vehicle 25% per annum on book value, furniture 12.5% per annum on book value. Bad debts written off during the year amounted to 72,000. Required taxable income for Royce Rubandi for the year 2015 and the tax payable, if any, by Royce Rubandi. So we are supposed to, number 1, required, we get the taxable income of Royce Rubandi. So we say it, whenever you are told to get the taxable income, first thing that you normally ask yourself, which approach am I supposed to use whenever you are taxing a business? Is it the gross profit? Is it the net profit method? From the question, we said net profit method is used when net accounting profit or loss or income is provided. From the question, there is nothing like that. And so if it is not there, so the first thing is to check if there is net accounting profit or loss or income provided. If it is not, then it is not provided, then automatically we use the gross profit method. Gross profit method, we said, we usually start with the sales. We raise the cost of sales. We know, you can remember how we said you get cost of sales: opening stock plus purchases less closing stock minus any item that reduced the stock during the year. We get the cost of sales. Then sales minus cost of sales, we get gross profit. Then we add taxable operating income, we list them, and then we list the allowable expenses, we list them. Now, and then we compare, we take gross profit plus incomes minus allowable expenses. But we say that before you do any question on the gross profit, determine the first item that you are supposed to use, the sales. Have you been given the total sales? If not, then the first thing that you do, you have to determine the total sales. 2, have you been given the total purchases? If not, then you have to determine the total purchases so that you can prepare the statement. So in this case, we ask ourselves, have you been given the total sales? In the question, we are only given the cash sales. But just above the cashes in the summary of cash transaction, there is trade receivable, telling you that there was some evidence we sold on credit. So how much did we sell on credit? So that we add to the cash to get the total. We said if you are not given the credit sales, you have to open the debtors or receivable account to determine it. Then you add to the cash sales, then you get the total sales. 2, have you been given the total purchases? If you haven't been given, then you have to determine. In this case, have we been given? No. We are only given one part of this purchases, the cash purchase. So, but were there some evidence there were some credit purchase? Yes. Just above the cash purchase, there is the trade payable. What does that mean? We had purchased on credit. So we have to determine the credit purchase. We add the cash purchase so that we can get the total purchase so that we can use it. So this is how you go about it to determine the total sales and total purchases. We say total sales is equals to the credit sales plus cash sales. The best way to do, you see the cash sales we have been given. What we need to find is the credit sales. Now leave a space here. When you're doing it on your own, leave like 1 or 2 lines here, where now you'll be posting the figures. When you get the credit sales, where you post the cash sales, where you post, so that when you add the two, you get the total. Then for you to be able to get the credit sales, we said you open the debtors or receivables account. So you come here after the 2 lines or so, debtors or receivable account. what you do once you open that account, balance at the beginning of the period, write it there. This is the data at the beginning, but don't look for it. No, you are just preparing a structure to help you to get the credit sales. Then you jump. The best way is to jump like 5 lines here, 5 or 4, and then the balance at the end, as we had said when we introduced to the taxation of the business, balance carried down for the debtors, you'll post them here, debtors, you'll post them, but don't look for them. It's just a structure. Then these lines represent where we will post the totals, but now balance at the end we'll post here. And then we come to the purchases. We haven't been given the total purchases. How do we get it? So we say total purchases is equals to credit purchases plus cash purchases. Now, as we have seen, we have even been given the cash purchase. So what we need to find is the credit purchase. To get the credit purchase, we open the creditors or payables account. Same case, we jump like 2 or 1 line here. Then you open the creditors or payables account. Now, for the creditors, we start with balance at the beginning of the period here. Balance brought down. That is for the creditors. There. Then jump like 4 or 5 lines, as we said with the other one, and then have the balance carried down for the creditors here. Then at the end, you'll get the total. You'll get the total. In this case, what we normally do, we go through the whole question. If we come across a cash sales, we'll post here. If we come across something that affects the debtors or receivable here, if it increase the debtors as we had said initially on this side, it will reduce the debtors on this side. Then we come to the creditors. If we come across something that affects the cash purchase here, if it affects the creditors, increase the creditors. Creditors being a liability, we post it on this side. Creditor, if there is any information that reduces the creditors, you put on this side, because as liability they reduce, you normally post them on this side. So let us go through the question and find out if there is any of such item. We start with the first paragraph. Don't ignore anything. We are told Lois Rubandi is a sole trader. She did not maintain proper accounting records, but has provided the following information relating to her income and expenditure for the year ending that 1st December 2015. There is no information that affects these items here, so ignore. Summary of the cash transaction for the year ending that 1st December 2015. We start with the debit. There is the receipt. On the side of the receipt, we have the balance brought down. Balance brought down at that point, it is the cash at the beginning. Cash at the beginning, we ignore. That doesn't affect. The next one is the trade receivable. So trade receivable, we have it here. And we can see it is on the receipt side, meaning we got money from the trade receivable. Trade receivables are debtor. Debtors paid. When debtors pay, it reduces the debtors. So we post it on this side. So receipt. They have paid. And they paid 1226,200. 1226,200. After that, there is cash sales. Cash sales, just below the cash sales that we have here, 5620,000. Place it there. After that, commission received. That doesn't affect. The other one is capital. Capital doesn't affect. We go to the payment side. Trade payables. If you have trade payables on the payment side, that means that they paid their payables. So meaning payables reduced. When payables reduced, you post on the debit side. So you come here, payment. Payment which we have 1005 200. Then we continue cash purchase. Cash purchase, just below the cash purchase where I told you to leave some space, 1620. 1620, 800. Then after that, salaries and wages, that doesn't affect. Rates and insurance doesn't. Medical bill for self doesn't. Transport doesn't. Bank charges, no. General expenses, no. Loan interest, no. New motor vehicle, no. Drawings, no. That's the drawings of cash. Then we go to the summary of assets and liability as at January 2015 and December 2015. We have furniture's written down value, no. Motor vehicle, no. Trade payables, yes. Here we have the balance at the beginning for trade payable, 985,000. 985,000. And the other one at the end is 1180,000. So 1180,000. After that, we have the inventory, no. Trade receivables, yes. At the beginning, 781 here. 781,000. Then at the end, 821,400 here. Now that is the time that you're supposed to post when you come across the figures or the items. Then salaries and wages due, prepaid rate, no. Commission received in advance, no. That doesn't affect. Capital, no. Additional information, number 1, discount allowed and discount received during the year amounted to 5,600 and 151,200 respectively. Now, discount allowed reduces the debtors. When you give debtors discount allowed, it reduces what they are supposed to pay you. So you come here, discount allowed. So discount allowed, which we have 5,600. And then we have discount received. Discount received, you receive from the creditors, people you owe money. So you have here discount received. Discount received, which we have 151,200. There. Then we continue. Number 2. During the year, she took goods for free from the business worth 100,000 for her own use. That does not affect any one of this. She just took goods from the business for her own use. Doesn't affect. Then number 3, depreciation was sustained as follows. Depreciation does not affect any one of this one. We go to number 4. Bad debt written off during the year amounted to 72,000. Bad debt does. So bad debt is usually from the debtors. That some people who have refused to pay and you have written them off. When you write them off, it means that it reduces what you are demanding from them. So we have it here. Bad debts written off. Bad debts written off, which we have 72,000. 72,000. Now you note that is the end of the question. Now what you do is to do the summation. Now we start with the debtors or receivable account. We want to know how much was the credit sales, which is supposed to be the balancing figure. The balancing figure. How do you do that? Take the totals on this side and write them here. We have 12, 26,200, and then we add 5,600, and then we add 72,000, and then we add 821,400, which we get 21,7,200. Then this one should be the same as on this side, 21,7,200. Then the difference between this figure and what we have posted on this side, if we had like 3, this one and the other 2, the difference is the one that we post here as the balancing figure. But we only have 1, so we minus 781,000, which gives us 1389,200. Now that we have the credit sales, we transfer here. So 1389,200, and then we now add the cash sales to get the total sales. So we add the cash sales, which is 56,20,000, and then 56,20,000, which give us 7,09,200. There. Now we come to the creditors. we want to get the credit purchase, which is supposed to be the balancing figure. We take the totals on this side, which is 1,005,200, and then we add 151,200, and then we add 1180,000, and then total, which is 23,36,400. Then we'll have the same here, 23,36,400. Then we minus the totals on this side. On this we only have one for now. If we had two figures, the three, we could have minused them. So 985,000, which gives us 1351,400. There we have the credit purchase. Now we can transfer the credit purchase here, 1351,400, add the cash purchase. So we add cash purchase of 1620,800, 1620,800, which give us 29,72,200. There. Now we have our total purchases and our total sales. From there we can prepare the statement. So we come here, the name of the business, it is the Lloyd Traders. So you come here, Lloyd Traders, sole proprietor, taxable income for the year ended, for the year ended 31st December 2015. So we'll have a column where we'll be posting the figures. And as we had said about the gross profit method, we start with sales, of which case now sales is the one that we have determined here, 7,009,200, and then we less cost of sales. For the cost of sales, we start with opening stock. Opening stock is in the summary of the assets and liabilities. Inventory at the beginning, 1241,600, plus the purchases. The purchases is the one that we determined here, the 2972. 2972,200. We minus the closing stock. Closing stock, which we have 14,8600. And then remember to minus any item that reduced the stock during the year. And we say items that reduce the stock during the year are like damaged, stolen, withdrawn stock. For this question, we only had one place. Number 2. During the year, she took goods for free for the business worth 100 for her own use. And they are goods. They must be goods, not cash or when silent. When silent, just ignore. Because in that case, you cannot assume they are goods. Only when they are goods or inventory that they do or we do come and deduct them here. So she withdrew 100,000. Now, having no other, we close the bracket and get the total. The total, that is the net, 1241,600, and then we add 2972, 200, 2972, 200, and then we minus 1480, 1480,600, and then we minus 100, which we get 33,200. And that will give us the gross profit. So gross profit, which would be, we take 7,900, and then we minus that figure, which give us 43,76,000. After that, we usually add other taxable operating incomes. Now, the best way to do it, instead now for you to go and look for the taxable operating income which you list here. Remember, we had looked at the topic on the on an area on taxation of operating income or taxable operating income. Now, instead of looking for them, it will be a waste of time. The best way is leave a space of like 3 or 4 lines here, and then now less. Remember, in the statement when you're using the gross profit, we said once you add the taxable operating income, you less allowable expenses. So you have left 3 or 4 lines, and then now you have less allowable expense. I want to underline because these are headings of the figures that will be posting, or the items that will be posting of the taxable operating income here and allowable expenses here. We need to go through the question, look for a taxable operating income which will be posting here, allowable expense here. We start from the summary of cash transaction because up there in the first paragraph there's nothing. The first under receipts balance brought down, we say that's the cash at the beginning of the period. We ignore. It is not an income. It's just a cash we had when we were starting the period. Trade receivable, that we used it to get our debtors here, our sales here. The other one is cash sales. It was used to get the sales. Commission received. Commission is an operating income, not an investment, and it is a taxable operating income. Now, having gotten the commission, what you do is this. Check around if there is any other place that commission has been mentioned. If you go to the summary of assets and liability, there is another commission received in advance. So what do you do? When you have it, somewhere else it has been mentioned, have commission income here. Then open a bracket of the information given. If something increases the item like commission add, it reduces the commission less. Like now, and also, if the commission is relating to this year, you add. If it is relating to another year, you minus. That's simple logic. Anything for this year, you add. Anything for another year, you minus. Like if we start with the commission received, you see it is that in the transaction for this year, commission is, so we add. We add 124,000. Then, in the summary of assets and liability, commission received in advance, and we have at the beginning and at the end. Now, if you receive commission in advance when you are starting the year, ask yourself, you are receiving it in advance for which year? Don't look at when it was received. Look at it is relating to which year. When you receive it in advance at the beginning, it is for this year. The year we are taxing, like in this case, it is the year 2015. Received in advance in January, it is for the current year. Yes, it was received last year, yeah, because it was received in advance by the beginning. It could have been, it must have been received last year, but it is for the current year. Anything for this year, we add. That's what we have said. So we have 80,000. Then commission received in advance at the end of the year. When you receive commission at the end in December, it must have been for the following year. So not this year, for the other year. So in that case, we minus 136. So we need to compute the net. So we say plus 124,000 and then plus 80 and then minus 136. which give us 68,000. 68,000. Then we go back to where we found that commission. We found it in the summary of cash transaction for the year. Then continue from there. Don't jump anything. Consider everything provided. After commission, there is capital. Capital, yes, it is not even an income, because capital, it is what the owner introduced into the business to assist him to run the business, you know. So that's not an income, and it's not even an expense. We go to the payment side. Trade payables, we used that to get the purchases. Cash purchase, we used it here. Salaries and wages, that is an expense. And salaries and wages, we said is a allowable expense. Unless it is related to the owner, it is allowable. So we'll have here salaries and wages. But as we said, before you post it, check if it is mentioned somewhere else. It is mentioned in the summary of assets and liability. Almost in the middle, there is salaries and wages due. Higher, we have to adjust it the way we said. We start with the one that was paid in this year. If it was paid in this year, it must be for this year. We add 1660, 400. Then we go to the summary of assets and liability. Salaries and wages due at the beginning. Due at the beginning, it must have been for last year, because it is what the arrears that were supposed to be paid last year, but they were not paid. So which year are they relating to? It is last year. Yes, it will be, they will be paid this year. Actually, they are in this 1660, 400, you know, because it's arrears for last year, they must have been paid here, but they are not relating to this year. The workers offered the service last year, only that they were not paid. So since it is not for this year, minus, and we minus the 184,000. And then we have salaries and wages due at the end of the current year. At the end of the current year, that is for this year now, because it is workers offered the service this year, only that we didn't have money to pay them by the end of the year, but they rendered the service this year. So the income was generated, the one he assisted to generate was for this year. That one we add. We add 150,000. Now, because there's nowhere else we have salary being mentioned, we can get the net. So 1660, 400, and then we minus 184,000, and then now we add 150,000. So in this case we get 1626, 400, which we minus. And it's also important for me to mention that this one we normally do it this way, instead of opening the salaries and wages account or even the commission account where you try to get for commission for this year, the one that you bring here, or this, it will give you the same, but that's a long process. It's a wastage of time. Just do it this way. Then we go back to where we found the salary. After the salaries and wages, there is rates and insurance in the cash transaction. Rates and insurance, that's allowable because they are for the business. They are allowable expenses. So we come here, rates and insurance. Now we check if it is mentioned somewhere else, that rates and insurance. Yes. If you go to the summary of assets and liability, there is prepaid rates, that last item. So we have to open a bracket there, and we start with the rates and insurance in that year. The one that was paid, it is for that year. We add, and we add 320,800. 320,800. Now when you come to the prepaid at the beginning, you see when you are starting the year, January, and you have a prepayment, that must have been for the current year. You are prepaying for the current year. That we add. We add 50,000. And when now you get to the end of the year and you have a prepayment, you are prepaying for the following year, which means whatever you paid this year, part of it was for next year, that one you minus. So we minus 72,000. Having no other place it has been mentioned, we get the net, which will be 320,800, and then we add 50,000, and then we minus 72,000, which give us 298,800. go back to where we found that rates and insurance in the cash summary. After rates and insurance, medical bill. Medical bill is allowable, but the problem this time is for self. And we said here, when you are taxing a sole proprietor, any expense relating to the owner, private expense, we don't allow. This we even said when you are looking at the general allowable and non-allowable expense. And an unallowable, anything to the owner, we don't allow. Private expenses. So that is not allowable. We won't deduct. The other one is transport. Transport is allowable and it isn't mentioned anywhere else. So transport. Transport, which you have 56,400. After transport, bank charges. Bank charges are also allowable. They are for business and they are not mentioned anywhere else. Bank charges. Which we have 3,000. 3,000. After that, general expenses. General expenses are also allowable. There are small expenses that are put together for the business. General expenses. General expenses, which you have 145,400. The next one is loan interest. Loan interest, we said interest on money borrowed and invested in business is allowable. So loan interest, allowable. Amount, 120,000. After that, new motor vehicle. Fixed asset, we said we don't allow. We allow capital allowance. Of which case we said motor vehicle, capital allowance at the rate of 25%. Capital allowance, written in short as CA, motor vehicle, 25%. But check whether you have the balance at the beginning. We take the balance at the beginning. If you go to the summary of assets and liability, at the beginning we had a motor vehicle, 960, of which case will be 960. Then add the one that was purchased in that year, which was 600,000. With nothing more, get the amount. That will be 960,000 plus 600,000, giving us 1560,000 times 25%, which give us 390,000. We go back and continue. After the new motor vehicle, drawings. Drawings, we said they are private expense. They are for private use. We don't allow them. Then we go to the summary of assets and liability. Furniture. Furniture is a fixed asset. We claim capital allowance on it. So we'll have capital allowance on furniture and fitting, in short. So 10% off. We start the balance at the beginning, 120. And there was no addition of furniture. There is nowhere we are told about addition. So we just take 10% of 120, which gives us 12,000. After that, we go back. Summary of assets and liability for furniture. We have considered motor vehicle. We had considered already. It's there. Capital allowance. Trade payables, that's not an income, not an expense. Inventory, not an income, not an expense. Trade receivable, not an income, not an expense. Salaries and wages, we had considered. Prepaid rates, we had considered. Commission received in advance, we had considered because we had met them earlier. Capital, no, that's not an income or an expense. Additional information, number one, discount allowed and discount received during the year were 5,600 and 151,200. Discount allowed is an expense and an allowable one. We'll have discount allowed. Which we have 5,600. Then discount received 151,200. That is an income and a taxable one. We had said that when we were looking at the general taxable and non-taxable income. Discount received, a taxable operating income, 151,200. Then additional information number two, During the year, she took goods for free from the business worth 100,000 for her own use. That's an expense, yes, but it's not usually allowable, we said, because it's for private use. Number 3, depreciation was ascertained as follows. Remember, we said depreciation is not allowable. What we allow are the capital allowance in taxation, which we have considered. So ignore. Depreciation is not allowed. Number 4, bad debts written off during the year amounted to 72,000. Trade bad debt written off are allowable. Unless we are told they are not relating to the trade, to the business, they are allowable. Bad debt. And take note, don't confuse with provision. Provision are the one that we say specific provision we allow, general provision we don't. Bad debt are bad debt, and they are allowable as long as they are relating to the business. Bad debt written off, which we have 72,000. Bad debt is the last item provided. So what do you do now? We are done. We now have to get, we come now to the end here, we get net taxable operating income. So from operation, how much is the total taxable income? That means that we take the gross profit plus this income minus the expenses, allowable expenses. We start with 4376,000. Then we add 68,000. And then we add 151,200. And then we minus 1626,400. And then we minus 298,800. And then we minus 56,400. We minus 3,000. We minus 145,400. We minus 120,000. We minus that 390,000. We minus 12,000. We minus 5,600. Then we minus 72,000. It gives us 18,260. So what we do is this. This being a sole proprietorship business, we had said earlier on, we tax the sole proprietor on his or her own income. So once you get the net taxable operating, add taxable investment income. So you add taxable investment income. If operating income is positive like this one, if the operating income is negative, you carry it forward to next year to be deducted against the profit of next year. Remember, we said we carry forward a loss up to a maximum of 10 years. Now, if you look at the question that we have, there is nowhere we are told about investment income for now. But if you had non-qualifying dividend, remember those are dividends which withholding tax is not final. Non-qualifying interest which withholding tax is not final. Royalty income for resident withholding tax is not final. Rental income for commercial buildings, for residential above 15 million per year, we should add them here. But for this question, we don't have, so we would have a dash. And so meaning we can now get total taxable income, which would be the same because the investment is 0, 18,600. And required number 1 ends there. Now we have the taxable income. What we had said, the first thing is to determine the taxable income. The second one now is to determine the tax payable. Criteria of determining the tax payable. Now we have to tax that income on that individual, and which we said that sole proprietor do not have separate legal entity from the business. So the income of the business is taxed on the owner. So how do we tax? We had said at graduated scale rates in the same way as employment income. So we want to look at how we tax that income. We are going to use the scale rate that was used in the year 2022. But the concept is the same. What happened is that if the rule changes, and the reason why we are looking at year 2022 because we are looking at the exam of December 2023. If the rule change, you find that the table just changed, but the concept of getting what you are, the computation is or remain the same. So I'm going to delete this part here so that we can see how we can tax the 18,600 to get the tax that is payable by this sole trader. So to come here, tax payable. So we want to get the tax payable. So if you look at the income that we have, it is 18,600. Now there is a table that is given by the examiner in an exam, or the question, as long as you are doing the question about tax, you will be given first page. And as you have said, we are using the table that was used in the year 2022, but it is relating to the year of income of 2021. But that's the one that we are going to use. So if you look at the top there, there's somewhere with the rates of tax, including wife employment income, self-employment income, and professional income rates of tax. Year of income 2021. Assume that the following rates of tax were applied throughout the year of 2021. We have the monthly taxable pay, annual taxable pay, rates of tax. Because we are taxing an year income, not 1 month. It was for the year ending 2015, 1 year. We use the annual taxable pay, which start between 1 shilling to 288,000. The percentage is 10%. Between 288,001 to 388,000, 25%. Excess over 388,000, 30%. So if you look at the income that we have there, 18,600, that means that we go to the excess of 388. So we have to tax up to the rate of 30%. How do you start? You start with the first. Now at the rate of 10%, pick the last amount appearing in that range. Between 1 shilling to 288, pick 288. So the last amount appearing there. So we say first 288,000 times 10%. It gives you shillings here 28,800. Then you come to the next. The next, you take between 288,001 to 388, 25%. Now we don't pick the last amount and we tax at 25 like we have done for the first one. No. You take the difference between the last amount appearing there, which is 388,000, minus the last amount appearing in the previous rate. In the previous rate, the last amount is 288,000. So 388,000 minus 288,000 give you 100,000. So to come here, 100,000 times 25%, which gives you 25,000. 25,000. After that, we go to the excess over 388,000, which we tax at the rate of 30%. Excess over 388 means what? It means that we have already taxed 388. If you take 288 plus 100, that will be 388. So whatever is above 388, you tax at the rate of 30%. How much is that? So this we call it last. The last, which is now the total taxable amount, 18,600. You less what you have taxed. You have taxed 388. 288 plus 100, that will be 388. So this one, you multiply by 30%. The excess now. So let us get the excess first, which would be 18,600 minus 388,000 gives you 14,32,600. Then times 30%, which gives you 429,780. Then, because that is the last one, you add those taxes to get something called gross tax. Gross tax, which would be the 429,780 plus 25,000 plus 28,800, which gives you 483,580. That we call it gross tax. Now, after you get the gross tax, there are 3 items you are supposed to deduct here, which are called set off. They are the same that we talked about when we were looking at the employment income, only that we don't have pay as you earn. Pay as you earn is usually for a person who is on salary. This is just a person in business is not on salary, so we ignore. But now, personal relief is one of the set-off we talked about, of which case personal relief is provided in the table. If you look at the table we have used to tax, just after the table there's personal relief per month 2,400. If you multiply by 12, you get per annum 28,800. The next one is called insurance relief, and we said this for a person who have education or life insurance cover or NHIF insurance cover, and I showed you how to compute. So if this individual had that, if this sole trader, that is a lorry trader, had the insurance life or education on NHIF, we could have claimed the insurance relief, but she didn't have, so we ignore. The other one is withholding tax on investment income, which withholding tax is not final. That means that you have to look at the investment income you have added here. If you had added something like non-qualifying dividend, remember there is a withholding tax of 15%. You'll come and say investment income, withholding tax 15% of the gross to remove it. But we didn't have. So for now, the only set-off we have is the 28,800, and this will give us the net tax payable. The net tax payable, which will be the 483,580 you minus the 28,800, which gives us 454,780, and that answers required number 2, where we were supposed to get the tax payable by Royce Lubandi, and it ends there. For now, that is how we usually tax the sole proprietorship business. We end our lesson there. Until next time, when we are going to look at the taxation of the partnership. Thank you very much. Yours here, Patrick Kamau Kamure. Hi there, my name is Patrick Kamau Kamure. You are a lecturer in public finance and taxation. Welcome to today's lesson. Today, we continue from where we stopped last time. Remember, the topic we are looking at the moment is called the taxation of the business income. And we said that there are 3 businesses that we need to look at how they are usually taxed: the sole proprietorship, partnership, and the limited company. So far, we have looked at the sole proprietorship. Last lesson, we did look at we started looking at the partnership, whereby after looking at how partnership is usually taxed, we went ahead and we used the net profit method to get the taxable income of the partnership. So today we continue with the same lesson, but we look at another question where we used a different approach to answer the same question, a different question using now the gross profit method. Welcome to today's lesson. So we are going to start by reading the question. After reading the question, then I'm going to help you solve the question. So here is the question. This is what the question says. Karimu and Shika commenced trading in partnership as Kashi on January 2019. They share profits and losses in the ratio of 2:1 for Karimu Shika respectively. The partners were to receive monthly salaries of 18,000 and 22,000 for Karimu Shika respectively. The partnership did not maintain complete set of accounting records. The following summary of the bank statement for that year has been presented to you. So we have the receipts consisting of capital introduced, Karimu and Shika, cash sales, receipts from debtors, sale of a van. We go to the payment side. Equipment of office, rent for go down, salaries and wages, purchase of for resale, repair and maintenance, insurance, interest expense, motor vehicle expenses, sundry expenses, motor van purchased, tax penalty, electricity, medical expenses, balance carried forward. Additional information number 1. The following payments were made in cash from the cash sales before banking. We have the motor vehicle expenses per annum. wages per annum, sundry expenses per annum, weekly drawings for Karimu and Shika. During the year, discount received from the supplier amounted to 132,500, while the discount allowed to customers amounted to 118,000. As at that 1st December 2019, electricity and insurance prepaid were 25,000 and 12,800 respectively. Depreciation was to be provided on equipment at 10% on a straight line basis. As at that 1st December 2019, the amount owed to supplier was 780, while the amount owed by the customer amounted to 1420. An amount of it 2,000 owed by Jamila Mamba, a customer, proved irrecoverable and is to be written off as bad debt. This amount was excluded from the total amount owed by a customer as at that 1st December 2019. Salaries and wages include the salaries to the partners. The go-down had been occupied since 1st November 2019 at an annual rent of 450,000. Included in the interest expense is the interest on partners' capital contribution at the rate of 5% per annum. The wear and tear allowance, and it's good to note that wear and tear allowance is the same as the capital allowance. So wear and tear capital allowance was agreed with the Revenue Authority to be 112,000 for the year ended at 1st December 2019. So number 11, closing inventory was valued at 620,000 on 31st December 2019. Assume that year of income had 52 weeks. Required, 1, adjusted partnership profit or loss for the year 2019, and number 2, distribution schedule of the profit or loss calculated in C1 above. So the first question is to get the taxable income, and we say that whenever you are told to get the taxable income of any business, you either use the gross profit approach or the net profit approach. Net profit approach, we said, is when you have been given net accounting profit or loss or income somewhere. If you haven't been given, you use the gross profit method. So this question, we are not given the net profit or loss or income. So automatically we use the gross profit method. Now gross profit method, we said, we usually start with the sales. We less the cost of sales. Cost of sales, we take the opening stock plus purchases, less closing stock minus any item that reduce the stock. And then we get the cost of sales. We less from the sales, we get gross profit. And the reason why we call it gross profit, we said. And then you add other taxable operating income, and then you less the allowable expenses. So, but we said before you start, always confirm. Do you have the sales? Do you have the total purchases? If you don't have, or you haven't been given, then in that case you have to determine them first. So in this question, we take note that we're starting with the sales. We are given only one, the cash sales. But the cash sales does not represent the total sales. We have to look for the credit sales. We add to the cash, we get the total. So now, we are not given the sales, so we have to look for it. The other one is the purchases. Have we been given the purchases? Yes. In the payment, in the statement of bank statement, there is a purchase for resale, but that is a cash purchase. Now, how about the credit? So in this case, we have to determine the credit purchase so that we can add to that cash, we get the total purchases. So this is what we said you normally do. To get the total sales, you do it this way. You say total sales is equals to credit sales plus cash sales. We said for the cash sales you'll be given, it is there, like we have seen it's already there. The issue is about the credit sales, where you have to determine it. Now, the best way to approach the question, we said, leave a space like 2 lines, where now you'll be able to open the debtors or receivable account to determine the credit sales. So you'll come here and have the debtors stock receivable. You start with balance brought down here. That's what we said for the debtors. And then jump 4 or 5 lines here where you'll be posting those items that affect the debtors. And then balance at the end here for the debtors. And then totals will be here. Same case on the purchases. We say total purchases is as a result of credit purchase plus cash purchases. For the credit purchase, we jump a space of 2 or 1 line, and then we have the creditors or payables account, where we will be able to get the credit purchase. Then for the creditors, you start with balance pro down here for the creditors, and then jump 4 or 5 lines, then have the balance carry down for the same creditors. And then you'll be able to post everything and the totals there. Once you have done that, now go through the whole question. If you come across some cash sales here, something affecting the debtors here, cash purchase here, anything affecting the creditors here. So we start. From the first paragraph, the only figures that we have are 18,022, which were monthly salaries to the partner. So those do not affect, so we ignore. We go to the receipt. Capital, introduced, that's not. Cash sales, yes, here. So we post it here, 700,000. And then receipts from debtors. Receipts from debtors, we said it reduces the debtors. Here, receipts, which we have 5,200,000. Then sale of motor van, that doesn't affect. We go to the payment side. Equipment for the office, that does not affect. Rent for the go down doesn't. Salaries and wages, no. Purchase for resale, yes. Here, that's a cash purchase, of which case we have 9,900,000. The other one is the repair and maintenance doesn't affect. Insurance, interest, motor vehicle, sundry expense. Motor vehicle purchase, that's a fixed asset, not goods. Remember, what we are looking for are for the goods. Tax penalties, electricity, medical expense, balance carried forward, those do not. Then we go to the additional information number 1. The following payments were made in cash from cash sales before banking, meaning what went to the bank, as we can see the bank statement was this. But before that figure was posted, not really this one, but the one in the bank statement, we had 12,700, this one. But before they banked the 12,700, they had paid some expenses, meaning our cash sales was more than what was banked. So to get the how much it was, we need to add the one that was sold on the one that was sold on cash and then used to pay the expenses. Which one? Motor vehicle expense. So the key thing there was from cash sales, were paid from the cash sales. Motor vehicle expense per annum, that we had 138,000. The other one is wages, 162, plus sundry expenses per annum, 35. Then weekly drawings by Karimu and Shika. So weekly drawings for the whole year, it has to be for the 52 weeks. So 52 weeks times, now weekly for the total, which is 7,200 plus 6,400. And that ends there. From there we go to number 2. During the year, discount received from the supplier amounted to 132,500. Discount received reduces the creditors, so we'll have it here. Discount received, which we had 132,500. The other one, while discount allowed to customers amounted to 118,000. Discount allowed, which reduces the debtors. Discount allowed, which we have 118,000. I want to bring this one a little bit up here, but I haven't changed anything. It's just this. And so we had said the balance carried down for the creditors. we leave it there. So we continue. After that, we go to the point number 3. As at 31st December 2019, electricity and insurance prepaid were 25,000 and 12,800 respectively. That doesn't affect. Depreciation was to be provided on equipment at 10% straight line. No. As at 31st December 2019, the amount owed to supplier was 780. Now, this at the end of the year, what the supplier are owing is 780,000. And then, while the amount owed by customer 1420. What is owed by the customer is 1420 at the end there. We continue. An amount of 82,000 owed by Jamila Mamba, a customer, proved irrecoverable and is to be written off as bad. This amount was excluded in the total amount owed by the customer as at 31st December 2019. So that's a bad debt written off. Bad debt written off reduces the debtors written off, which we have 82,000. 82,000. The other one is number 7. Salaries and wages include salaries to the partners. That doesn't affect. Number 8, go down had been occupied since 1st November 2019 at an annual rent of that. Doesn't affect. Included in the interest expense is the interest on partners' capital contribution at the rate of 5% per annum. Doesn't affect. The wear and tear allowance was agreed with the Revenue Authority to be 112,000 for the year 2019. Doesn't affect. Closing inventory was valued at 620 on that 1st December 2019. Doesn't affect. So we are done. So from there we do the computation. So we are going to add the totals on this side and compare to the total on this side. Actually, we have seen the balance brew down is 0 and also balance brew down here because they started the business at the beginning of the current year. So there was no balances from last year. So it's all about the total on this side will be now the credit sales here. Credit sales. So we add them 5,200 thousand plus 118,000 plus 82,000 plus 1420, which gives us 6820,000. And this one 6820 should be the totals. 6820 because we now have written the balancing figure. So then this one we transfer it here 6820,000, which we should be able to add now the cash. So we'll start by taking 7,200 plus 6,400 times 52. So it will be 7,200 plus 6,400 times 52 weeks because that was per week. That becomes 707,200 plus 35,000 plus 162,000 plus 138,000 plus 700,000. Then now we add this one plus 6820,000. 6820,000 giving us 20,200,200. That is the total. We come here, we add this plus this. This is 0, so that will be the credit purchases. So this plus this 132,500 plus 780,000. So that will be 912,500, which will be here 912,500. 912,500. We transfer that one here 912,500, and then now we add the cash purchase. So plus 9,900, which give us 10,812,500 there. With that one now we can prepare the statement of determining the taxable income. So we'll come here, the name of the partnership is Kashi Enterprise Partnership. We get the taxable income for the year. ended 31st of December 2019. So we start with the sales, which we had determined 20, 562,500. Then we less cost of sales. Cost of sales, which we take the opening stock. But here you'll note that we were not given the opening stock because we started the business at the start of this year. So there were no opening stock from last year. So 0 plus the purchases. Purchases is what we have determined here. 10, 8, 12, 500. Then we minus the closing stock. Closing stock is the one given in point number 11, 620,000. So minus 620,000. And then we also minus any item that could have reduced the stock during the year. Damaged, withdrawn stock, stolen, of which case the whole of this question, we didn't have any stock that was stolen, damaged, or withdrawn by the partners. There was none. Let me confirm properly. There wasn't any. The drawings that we are given in additional information, number 1 was cash drawings, not goods. So in this case, we cross to get the cost of sales. Cost of sales, which will be the 10, 8, 12, 500, you minus 620,000. And that gives us 10, 192, 500. And then we can be able to get the gross profit. Gross profit will be, we minus that from 20, 562, 500. And that gives us 10, 370,000. Then we said this, after getting gross profit, and the reason why we call it gross profit method is to add other taxable operating income. Other taxable operating incomes. Other taxable operating incomes. Of which case we said you jump a space of like 3 lines and then you less. I want to bring this one here, 1,000. So you less allowable expense after jumping around 3 lines. Allowable expenses. So what we do now, we go through the whole question. If we come across a taxable operating income, an allowable expense, we post here. We start from the top. The first paragraph was about the salaries to the partner. We said anything to the partner we don't allow. It's an expense yet, but not allowable, so we cannot post. We go to the summary of the bank statement. On the receipt side, capital is not an income or an expense. Cash sales, we used it to get the sales. Receipts from debtors, we use it to get the sales. Sales from the van, we said income from selling fixed assets, we don't tax, so we cannot post here. We go to the payment. Equipment. Equipment is a fixed asset, which we should claim capital allowance at the rate of 10%. But we won't do that. Why? If you look at additional information number 10, we are told the wear and tear allowance, which we said is the same as capital allowance, was agreed with the revenue authority to be 112,000. So that's the one that we use. Anywhere we require to compute capital allowance, we use that. So we can even post it now. The capital allowance, also called WTA or wear and tear allowance for the year. It was agreed to be 112,000. From there, we go back to where we found that in the bank statement. After equipment, rent for go down. That's an allowable expense, rent expense. But we have an additional information to that rent. If something has an additional information, check it out. In additional information number 8, the go down has been occupied since 1st November 2019 at an annual rent of 450. So annual is per year. And now it was occupied from 1st November. Those are 2 months. So forget about the one that you are given. Use the one that you can get for this particular year. So in this case, we are going to take 2/12 times the 450 because it was only occupied for 2 months to the end of the year in this particular year. So this is going to be 2/12 times 450. That will be 75,000. That is the one that we allow. Any other, we forget. Then we go back. After the rent for the go down, salaries and wages. That is allowable. But we have to check whether it is mentioned somewhere else. Salaries and wages. Yes, it had been mentioned in additional information number 7. The salaries and wages include the salaries paid to the partners. Salaries. And here they have made it very clear that it is salaries and wages. Another place that we have wages now mentioned is number 1. The following payment made through the cash from the banking. So we have the wages. So what do? We'll come here and have the salaries and wages. So we open a bracket. Remember, we want to know the allowable salaries and wages for this year. 890,000. And then now we have to add the one that was paid through the cash. This was through the bank. The cash was 162. And then number 7, it includes the one paid to the partners. So we have to remove because we said anything to the partners we don't allow. To the partners was how much? In the first paragraph is where we were told the monthly salaries to the partner was 18 and 22,000. Monthly, underline monthly. So meaning to get the whole year, we have to take minus 12 times 18,000 plus 22,000. So that we can get, and since it is not mentioned somewhere else, we do the computation. So we take first of all the 18,000 plus 22,000, and then you multiply by 12 months because it was monthly. We get for 80,000. Then we remove them from this. So we take 890 plus 162 minus 480. That gives us 572. That's the one that we should be allowing there. After that, we go back to where we found the salaries and wages. After salaries and wages in the bank statement, purchases for resale, that we used to get the purchases up there. Repair and maintenance, that is another allowable expense. Repair and maintenance. So we check if it is mentioned somewhere else. There isn't. So we just pick the figure as it is, 860,000. After that, we go back. After the repair and maintenance, there is insurance. Insurance is also a allowable expense. So we have insurance. Is it mentioned somewhere else? Yes. Additional information number 3. As at 31st December 2019, electricity and insurance prepaid. So this was prepaid and it's at the end of the year. We said prepaid at the end of the year is for next year, not for this. Anything that is not for this year, we minus. So we are going to take the insurance of 62.5 and then we minus the prepayment which we have 12,800. That will give us how much? This will be 62. 500, we minus 12,800. That gives us 49,700. After that, we go back to where we found the insurance. After the insurance, there is interest expense. Interest, we said, is allowable. So interest expense. But it is mentioned somewhere else. In additional information number 9, Included in the interest expense is the interest on partner's capital contribution at the rate of 5%. Included in interest. Anything to the partner we don't allow. So we will take this interest, which is 612,000, and then we minus the one that was paid to the partners, which was 5% of the capital. The capital is in the bank statement, where we have for the two partners 3,500 plus we have the 2,500, that is 2,500,000. That. So we add the capitals, which are 35 plus 25 times 5%, which give us 300,000, and we minus from 612, that give us 312,000. That's the one that is allowable, the one paid to the partners. Then we go back after the salary, after the interest, after the interest. Motor vehicle expense. Motor vehicle expense is allowable, and we say that is not the cost of motor vehicle, it's the vehicle expense incurred to run the motor vehicle, fuel, repair. So in this case, that is allowable, not a fixed asset. Motor vehicle expenses, where we are told the motor vehicle expense is 186,500. After that, we have sundry expense. Maybe there is something that I should have confirmed. In additional information number 1, there is more motor vehicle expense. The one that was paid in cash, 138. We forgot about that, so we should add it. So it will be 186,500 plus the one that was paid cash, which we have 138,000. 138,000. We check if it is mentioned somewhere else, but the motor vehicle is not mentioned anywhere else. So what does that mean? Then that means that we do the computation. 186,500 plus 138,000, which we get that 245,000. That 245,100. Then we go back after the motor vehicle expense. We have sundry expense. Sundry expense is an allowable expense, so we continue. Sundry expenses. And this one again, it is mentioned somewhere else in additional information number 1, the one that was paid through the cash. So we'll have 218,000, and then we add the one that was paid through cash, which we have 35,000, which we have 218 plus 35,000, which give us 253,000. Then we go back after the sundry expenses. Motor van purchased, that's a fixed asset which we should claim capital allowance. But remember, we were already given the capital allowance, so we ignore. Tax penalties, we said any expense relating to tax we don't allow. Electricity expense, that is allowable. So electricity expense, but we check for the additional information. If you go to the additional information number 3, we had electricity prepaid, and we said prepaid is for next year. So that one we need to remove. We need to minus, because of what was paid this year of the electricity, 45,800. Part of it is for next year, and so we should minus from here, where we have the 25,000. That gives us 2,800. Then we go back to where we found that. After the electricity, there is medical expense. Medical expense are allowable unless we are told it was relating to the partner, which we haven't been told. So medical expense. Medical expenses 630,000. Then now we go to the additional information for any taxable, operating, or allowable expense. Additional information number 1, the following payments were made in cash from cash sales. Motor vehicle expense we have considered, wages we have, sundry expense we did, weekly drawings, those are not allowable expenses. Additional information number 2, those are the figures for the balances of debtors and creditors at the end of the year. So they are not incomes or expenses. Number 3, we have already adjusted for them. Number 4, depreciation. Remember we said depreciation is not allowable. We claim capital allowance instead, which we have been given. Then number 5, as at 31st December 2019, the amount owed to supplier was 780, while the amount owed by customer was 1420,000. That we had said actually, there's additional information we jumped. Number 2, during the year, discount received from the supplier amounted to 132,500, while the discount allowed to customers amounted to 118. Discount received, that we know is a taxable operating income, so it should come here. Discount received, that is a taxable operating income. And we have the discount received of 132,500. And then we have the discount allowed. Discount allowed is an expense and it's allowable. Discount allowed. Discount allowed, which we have been given as 118,000. There. From there we continue. We were actually in point number 5. That's where we were saying that we had the balances at the beginning and also at the end. And then from there, number 6, an amount of 82,000 owed by Jamira Mamba, a customer proved irrecoverable, and it is to be written off as bad debt. This amount was excluded in the total amount owed by the customer as at 31st December 2019. That is a bad debt written off, which we said is allowable expense. So we'll have bad debt written off. Bad debt written off, which we have an amount of 82,000. After that, we go to number 7 now. Salaries and wages include the salaries paid to the partner. Now that we had adjusted in the salary here, if we had forgotten, now you should be able to adjust. Number 8, we had adjusted on the rent. Number 9, we had adjusted in the interest. Number 10, capital allowance we had posted. Closing inventory that we used to get the cost of sales here. There is nowhere else it's supposed to be used. Now that is the end. What remains, and this being a partnership, it should end here, is to get the net taxable operating income. So how do you get the net taxable operating income? It is the gross profit plus discount received minus these expenses. So we do the computation. So we start with the 10, 370,000 plus 132,500 minus 112,000 minus 75,000 minus 572,000 minus 860 minus 49,700. Remember this was 7. 49,700 minus 312 minus 324.5 minus 253 minus 2,800 minus 630 minus 118 minus 82,000. That gives us 7,093,500. And that answers required 1, where we are supposed to get the taxable profit of the partnership. With that one, we are supposed to go to the required number 2, where we do the income distribution. So the income distribution schedule, this is what we said or how it is supposed to look like. So income distribution schedule. We start by distributing the operating income. So we will start with taxable operating incomes, which is the one that we have determined here, 70, 93, 500. And then now we list the partners that we have, which we have Karimu, Shika, and now the totals. So we go through the question. Remember, we start by looking for the first four items that we said: the salary, interest on capital, commission or bonus, less interest on drawings. Those four. So if you look at the first paragraph, we had the salary to the partner, salary, which we were told it was per month. So the first one was to get 18,000 times 12. The other one was to get 22,000 times 12. Because they were monthly amounts. So we have 18 times 12, which give us 216,000. So 216,000. The other one is 22,000 times 12, giving us 264,000. And now we have the total plus 216, 480 for 80,000. Then we go to the capital, to the cash bank statement. In the bank statement on the receipt, we had capital, which is not one of the item we are posting. You go to the payment side, there is none. You go to the additional information, number 1, drawings we said we ignore. Number 2, no. 3, no. 4, no. 5, no. 6, no. 7, we have posted. 8, no. 9, there is interest on capital. So interest on capital, which is supposed to be 5%. 5% of the capital. How much is the capital? In the bank statement, we have capital of 35. And also, the other one is 25 for each. So we start with 5% of 35, which gives us 175,000. The other one is 25 times 5%, giving us 125,000, and the total gives us 300,000. Then after that, point number 10, none, and 11, there is none. So the only remaining one is the fifth one, profit share. How do you get the profit share? We said you take the taxable operating income we have, like in this case we have 70, 93, 500, and then you minus what has been shared already. We have shared the 480,000 and also shared the 300,000. So whatever remains you share according to the profit sharing ratio. And what was the profit sharing ratio? In the first paragraph, they were sharing 2 to 1. So the first one will get 2 out of 3. The other one 1 out of 3. So let's minus 70, 93, 500. We minus 480. And also we minus 300,000. 480,000 and 300,000 give us 6313. So 6313, 500. Then the first one will get 2 over 3. That give us 4209. 4209, 900. 1,000, sorry. And there now the other one. We can take the 6313, 500 minus what we have given this. 63, 13, 500. That will give us 2104, 500. And now we can get the total taxable operating income. total taxable operating income. So for Karimu, it will be 216,000. We add 175,000. We add 4209, which we get 4,600,000. The other one will be 264,000. We add 125,000, and then we add 2104, 500, which gives us 2493, 500. And now the total, which would be 480,000 plus 300, and then we add 63, 13,500, which give us 1793, 500, and which is the same as the operating income we had determined. Remember, if we had an investment income that is taxable for this question, after getting the operating income, we add taxable investment income, and we share and then get total. But the whole of this question didn't have an investment income. So meaning our question then should end here. So this one will give us now the total taxable income, which should end there. That is how we tax a partnership when you have not been given the net accounting profit. So for this question ends here. And now what is remaining is the taxation of the limited company, which we are going to look at in our next lesson. For now, we stop there until we meet in the next lesson. After this video, there is some assignments, questions that you can attempt. Kindly do attempt and then see if you can be able to do the way we have done it. Thank you very much.
Hello learners, and welcome to the Business Data Analytics session. I am your illustrator, Nicholas Sikali. Today, we are going to tackle a question on the statement of cash flows and see how we can be able to solve a question on the statement of cash flows using Excel. The question that we are going to use is the one that was brought by Kasneb through its pilot paper that was released recently. A sample of the pilot paper is what we have before us here. So I'll be opening a sample of the pilot paper so that we can see how it looks like and how your questions are going to look like. So this is the pilot paper, a sample that was just released the other day. The pilot paper for Business Data Analytics, which is a practical paper, consists of two sections. We have section 1, which has a total of 40 marks, and it is tested through multiple choices, because in this section, students are required to pick the correct choice from the given multiple choices. Now we also have section 2. Section 2, which is a total of 60 marks, is where now you'll be required to solve much of these questions using Excel. Like there is question 21, which you are required to prepare a spreadsheet showing a forecast statement of profit or loss, of course, for the next 3 years under the scenarios that have been given here. So this is a sample of how you can be able to prepare such a forecast of the statement of profit or loss, of course, using the rates given. Then we had question 22, that is the Rubini Limited, where students were required to prepare a statement of cash flows, of course, for the years ended 30th June 2021 and 30th June 2022, still using Excel. Then there was question 23, where you are required to apply your financial management knowledge to be able to solve this question here. Of course, it has aspects of net present value, discounting rates, and all those other items. Today, we are going to solve the question on statement of cash flows. This is question 22, where it's reading, you are provided with the following extracts of the statement of profit and loss and the statement of financial position for the Rubini Limited for the years ended 30th June 2020, 2021, and 2022. Of course, this is the statement of profit or loss extract for the 3 years. Then we have the statement of financial position as well for the 3 years. Then we have the required, prepare the statement of cash flows for the company for the 2 years ended 30th June 2021 and 30th June 2022. Of course, to be able to do this particular question, especially part A on the statement of cash flows, we will export or convert this PDF file to Excel. So I'll be able to provide or convert this particular file to Excel using the tools that are available. And once converted to Excel, we will be able now to solve it. So here it is. I've pulled the same question. That is the Rubini Limited statement of profit or loss extract for the years ended 30th June, course 2020, 2021, and 2022. This is the exact question that I've pulled from the PDF format. Now it is in the format of Excel. And having gone through it, we have required prepare the statement of cash flows for the 2 years ended 30th June 2021 and 30th June 2022. Of course, all that gives you total of 8 marks. Your knowledge of preparing the statement of cash flows has it that there are 2 methods of preparing the statement of cash flows. We have the indirect method, and we also have the direct method. Remember, the indirect method is where you are required to adjust your profits, of course, your bookkeeping profit, for the effects of those items which are not cash in nature, like depreciation, amortization, and impairment. You also adjust that for the items or transactions which are not operating activity, things like gain or losses from the sale of non-current asset. And we also adjust it for the effect of accruals. So if there is any accrued expense, you're also supposed to adjust for it for you to be able to get cash generated from operating activity. Then we have the direct method of preparing the statement of cash flows. The direct method is used where all the information that will enable you to get the gross cash receipts and gross cash expenditures or payments, of course, those methods of getting such things have been provided. Now, in our question here, we can be able to use both direct method and indirect method, but I'll go straight and use the indirect method of preparing the statement of cash flows. So cash flows are categorized into 3. We have cash flows from operating activities, we have cash flows from investing activities, and finally we have cash flows from financing activities. So we are going to start with cash flows. Cash flows from operating activities. Cash flows from operating activities. That is the first heading of cash flows here. From operating activities. I'll, of course, make that bold, and I'll also underline that. I'll bring the currencies, or before the currencies, I can be able to bring the years. They said 2021. I'll also bring the other one. That is 2022 as the year. I'll also bring 2022 that way. Maybe I can center that it is well centered like that. Perhaps this could be here this way, so that I bring the currencies for those respective years that way. This one can also be made to be bold. Then our cash flows from operating activities. For you to be able to get cash flows from operating activities using the indirect method, then it means that we can use any of the profits here. You can start with the operating profit, that is profit before interest and tax if you want. You can start with the profit, this is profit before interest and tax. There is profit before tax. There is also net profit. There are 4 profits here that you can be able to use. There is net profit. there is profit before tax, there is profit before interest and tax, and if you so wish, you can even start with operating profit. So depending on the profit that you start with, of course, that is what will really matter when making adjustments here. Like if you start with operating profit, then there will be no need of making adjustments for depreciation, which we see here. If you start with profit before interest and tax, then of course you must adjust for depreciation. And of course, when you start with the net profit that is below here, then it means you also adjust for so many items there. So I'll pick profit before interest and tax. Profit before interest and tax there. I'll not make it bold. So profit before interest and tax in this particular case, this one for 2021, profit before interest and tax for 2021 is that. Then we also have profit before interest and tax for 2022 is this. So Control V there. So Control V, so that is profit before interest and tax. Once we have profit before interest and tax, of course, we will add back. What can we add back? Profit before interest and tax, we'll add back depreciation. So depreciation was given as 800 and 750. So I'll be adding back depreciation. So add back depreciation. Add back depreciation. Of course, this one is not to be bold. This one is not to be underlined. So depreciation is 800 and 750. So I'll use 800 here. And I'll use 750 there. And 750. So it's supposed to be in bracket. So I'll adjust this. More number formats. I'll go to custom, scroll down, and find the one that is exactly showing that, which is here. I'll click on it, and of course you can see it's in bracket now. So you add back depreciation. You check for any other thing to add back. If at all given in the additional information, there was nothing like that. Of course, for profit before interest and tax, it means finance cost is yet to be deducted. Tax expense is also yet to be deducted. So you won't adjust for those. Then this will give you operating profit. Operating profit before working capital changes. Operating profit before working capital changes. That will be given by this. I think something is wrong somewhere. We are adding back depreciation. So that is 800. And this one is 750. So yeah, 750. So that we get equal sign. So we are adding it back because it had been deducted before arriving at profit before interest and tax. So remember, depreciation had been deducted, so you add it back. So this is that plus this. Get that. Then again, equal sign, this plus 750. And it will give you your answer of 27,506. So that is profit, operating profit before working capital changes. Now we want to go to changes in working capital. When we talk about working capital, we are referring to inventory, we are referring to receivables, and we are referring to payables. So we are going to look at those items and see how they changed. For starting with the inventory, and you check 2020, 2021. So inventory here was 15, here it was 21,750. So that is the increase in inventory. So increase in inventory. When you talk about increase in inventory, that one is an outflow. When inventory increases, it means that you went and purchased inventory. So increase in inventory will be given by what we had here. You subtract this, then you'll get your increase in inventory, of course, which is an outflow. So that is increase in inventory. Here it will be equal sign. Inventory increased from this minus 27,488, And of course, the increase in inventory there is 5738. Of course, 5738. So this will be there. It is fine that way. Then there is also receivable. It's also increasing. So we also have increase in receivable, increase in receivables, so equal sign. Now receivables are increasing from this cost minus this, so that is increase in receivables. On the other side, receivables is increasing from 8750 cost minus 15460, and that one gives you that increase in receivables. Then we look at payables. Payables, they are also increasing. So increase in payables. Remember, increase in payables are inflows and not outflows. So increase in payables, it means you've received more money or you went and purchased goods on credit. So that one is treated as an inflow. It will be equal sign. Increase in payables, now we use this minus this one, it's an inflow. The other one will be equal sign here minus this, and that one is increase in payables. So that becomes increase in payables there. After that, we will be getting the cash generated. Cash generated from operations. Cash generated from operations. Cash generated from operations. The spelling of operations looks wrong. That is cash generated from operations. Now on cash generated from operations, it will be the aggregate of what we have here. It's operating profit before working capital changes, plus increase in inventory, plus increase in receivables, plus increase in payables. You'll get your cash generated from operations. The same, equal sign, this plus here, plus here, plus increase in payables. Of course, you get the cash generated from operations. So that is cash generated from operations. Once you have that, of course, we move to finance cost paid and also income tax expense paid. So finance cost paid and income tax expense paid. We check if at all there is any additional information that would affect that to necessitate a control account, but there is none. So finance cost paid, finance cost paid. So finance cost paid here will just be what we have here. Finance cost paid, let's use minus. So the finance cost paid is 7,000 here, 7,000. So you can as well just say equal sign 7,000, equal sign 7,000. The other side, equal sign 9,000. So you can see equal sign 9,000, it takes this. So that is finance cost paid. What about income tax paid? Income tax paid. So the income tax paid, the same tune. There is this 4343. Then again equal sign 5327. That gives you 5327. So that is income tax paid. This will give you the net cash flows from operating activities. Net cash flows from operating activities, which will be the aggregate of cash generated from operations plus finance cost paid plus income tax paid costs, and you get 2840. The other side, this is 16,389. You add 9,000. You add 52. Remember, the ones that are in bracket are outflows, so it will just deduct and give you the answer. So that is 2062. So that is net cash flows from operating activities. Net cash flows from operating activities. After that, we move to cash flows from financing activities, not financing but investing activities. From investing activities, cash flows from investing activities. And on cash flows from investing activities, of course, we'll be seeing the changes in property, plant, and equipment. Remember, this property, plant, and equipment can only be affected by three things. One, acquisition of new property, plant, and equipment. Two, revaluation of property, plant, and equipment. Three, a disposal of property, plant, and equipment. That is if the PPE has been stated at cost. But if the PPE has been stated at net book value, then depreciation as well will be affecting property, plant, and equipment. So what we have here, reported as PPE, I believe is at net book value, and it will as well be affected with depreciation. Now, the only change here that we are going to get on investing activity will be, of course, whether it's acquisition of property, plant, and equipment. We are going to see that. If this is the opening balance of property, plant, and equipment for 2020, then this is the closing balance, which has increased so immensely. You can see from 25,800 to 45,200. That can only tell you one thing. The business purchased new items of property, plant, and equipment. Remember, there is no revaluation. Under equity here, there is no revaluation. So there was no revaluation that was carried out. So the only thing that affected property, plant, and equipment must have been acquisition and depreciation. So it's acquisition and depreciation. So what we do for you to be able to get what was purchased is that you take balance at the end. Of course, balance at the end. On it, you will add depreciation that was charged. Depreciation that was charged. Then you deduct the balance at the beginning. That will give you what was purchased during the year as far as property, plant, and equipment is concerned. So that is cash paid to acquire PPE, or you can write it in full, property, plant, and equipment, to acquire property, plant, and equipment. So the solution will be equal sign. You take the balance at the end, that is at the end of 2021, add depreciation that was charged during the year. It's better we choose this, same as this, yes, but I want to use this because this is what that will be, the one that will give us adding. If you use this, it will be subtracting, which is wrong because they are in bracket. So we'll be using 800. You add 800, so I've clicked on 800. You less balance of PPE at the beginning of the year, which is 25,800. So you click on 25,800. What remains here there is what was paid to acquire. That is the balance on the debit side of PPE account, which gives you 20,200. The same case as this, equal sign. The balance at the end of the year 2022 is 46,700. So you click on 46,700. Add depreciation charge for the year was 750. Then you less balance at the beginning of the year, which was 45,200. So we have 45,200 here. Then you enter. That gives you 2,250 as cash paid to acquire property, plant, and equipment. But they're supposed to be outflows, of course. They're supposed to be outflows, so we'll find a way of making them outflows. Let's see. If we go to custom, click on OK, it's still not bringing. So we will find a way of having that. The answer was, let me move back. You can see the answer is 2,200 and 2,250. So 2,200 and 2,250. 2,200 and 2,250. 2,200 and 2,250. So this is 2250 because it's an outflow. This one should be 2200. It was 2200, I believe. 2200. Let me confirm. Must have been 2200. Yeah, 2200. So this one is also 2200. So it needs to be in bracket because it's an outflow, 2200 and 2250. So I believe you've seen how we got 2200 and 2250. Now there is no any other investing activity apart from that. There are no other non-current asset that we can use. So we'll be getting net cash flows from investing activities, net cash flows from investing activities. Of course, the same answer that we have here. The same answer that we have here, net cash flows from operating activities. I want this bold because it's such a major heading. Then finally, cash flows from financing activities, cash flows from financing activities, cash flows from financing activities. Now on cash flows from financing activities, you will be looking at the long-term borrowings and you'll be looking at the equity, how the equity changed, Now on long-term borrowing, you can see it's increasing. Long-term borrowing here is increasing. When it's increasing, it means it's an inflow. You borrowed more funds, so it's an inflow. So equal sign, that is increase in long-term borrowing, and it will be equal sign this minus the other one, because of course it's an inflow. The other one is also increase in long-term borrowing, 60,000 minus 46. That is also an increase in long-term borrowing. Then we go and check what happened in equity. Paid up capital remained the same, so it means that there was no change. Look at what happened in retained earnings. We want to assess and check whether there was dividend paid or not. Now look at this. There is retained earnings balance brought down of 7080. Balance brought down of 7080. Now on this balance brought down of 7080, the balance carried down was 3053. So we want to see how. Of course, 7080, let's just see this one, 7080. If you add profit for the year, remember there is profit for the year 2021 here. So you click on that, it gives you 3053, which is the 3053 that is here. So it means there was no dividend that was paid. So there will be no dividend. Let us also test the last one. Equal sign. They started the profit of 30. They ended with a profit of 15,482. We want to see how. So balance brought down of 30, 53. Add profit for the year of 12. There's a profit for the year of 12,429. Let's see if we'll get the 15 here. If you enter, the answer is 15,482. So that is fine. Again, there was no dividend that was paid. So it means this will be the only cash flows from financing activities. So that will be net cash flows from financing activities, net cash flows from financing activities, net cash flows from financing activities. Of course, it is the same answer that we have there, the same answer that we have here. The last part is to aggregate all the cash flows and get cash and cash equivalents. Cash and cash equivalents. That way. So cash and cash equivalents for the year is an aggregate of cash flows from operating activities, add cash flows from investing activities, add cash flows from financing activities. So equal sign 2840 plus 2200 plus 13334. So that is 4026. The other one, equal sign this plus that plus this. We will get 13145. Cash and cash equivalents brought down. Then we have cash and cash equivalents carried down. So cash and cash equivalents brought down, because that has been given, equal sign. The cash that you started with in 2021 was the cash that ended in 2020. So cash and cash equivalent here is 0. Add bank overdraft that was here, 5297. Of course, you get 5297, but it should be an overdraft. So equal sign 0 minus this. So it's an overdraft. The other one, equal sign 0 minus 9322. It's an overdraft of that one. Now cash and cash equivalents, when the period was ending, of course this will be equal sign this plus that. 9323. 9323 is the answer. Here you can see that cash at the end of the year, that is 2021. If you move down with the 2021, 0. Then this one is an overdraft of 9322. 9322. So this and this should be the same. They should be the same. 9322. This one is 9323. So they are not. Equal sign. Let us test the other one. This plus this. That is 3823. 3823. 3823. Let us confirm. It is an inflow. There is money. There is cash at the end of the year. 3823. Look at cash. The overdraft is 0. The other amount is 3823. So this is correct. 3823. 3823. You can see 3823. 3823. The other one is an overdraft of 9322. Overdraft of 9322. Here we got 9323. So there's a difference of 1 for the cash flow that we prepared for the year ended 30th June 2021. So this is how you are supposed to deal with this question on preparation of the statement of cash flows, of course using Excel. The same thing that you know, but can you do it using Excel? That is the big question. Can you do the same thing using Excel? And if you can, then it means that you can be able to prepare a statement of cash flows. In our subsequent classes, we are going to look at other questions that were in that pilot paper, more specifically the question 21 on section 2, which required us to prepare a spreadsheet showing the forecast statement of profit or loss for the year, for the next 3 years under, of course, each of the 3 scenarios. But that will come later. For now, I would like you to comprehend this and see if you are able to repeat whatever happened here. Bye for now, and see you in our next session. Welcome to our another lesson on Introduction to Microsoft Excel. In our previous lesson, we started on working on how to work with basic formulas and functions in Excel we looked at the formulas, among them addition, we looked at subtraction, we looked at division, we looked at multiplication, and we also looked at power in cells. So these are the formulas that we looked at last time that we had a lesson. Today, I want us to pick up from where we left and talk about more formulas about the same thing. We are going to talk about average. We are going also to talk about maximum. These are now statistical formulas. We are going to talk about minimum. How do you get the minimum value? We are going to talk about count. We are going to talk about mode. And we are also going to talk about some more formulas here. We are going to talk about standard deviation. Standard deviation, and maybe before I forget, there's also median that is to be done under the statistical formulas on basic formulas in Excel here. So this is what we want to cover, and it will be an extension of the work that you already have. Remember, we had this particular work that we used on our formulas last time. So this one is going to be an extension of what we already covered in our previous lesson. Let us begin by looking at average. So how do you get the average of some marks that you have with you? So average is operated the same way as what we did in the other formulas like addition and also getting the product. So you can average in cell, you can also be able to average in range. Let us start by averaging in cell. Of course, every formula is preceded with an equal sign, then average, then you double click on average, that will appear there. Then you can click on the cell that you want, or you can type it manually. So in our case, let us click on, we want to get the average of Tom. So I'll click on 65. Then now we separate them with commas. So 65, then comma, 84, then comma, 70, then comma, 76. And if that is the end, you close the bracket, shift, and the sign of closing the bracket on the keyboard. After that, you enter. And it will give you the average for Tom for all the units as 73.5. So this is the average, and you can be able to copy it down all the way to the last one, which is not Juliet. I believe there is something wrong there. On our product, in our previous class, I believe we might have included wrong items. Let me just confirm what we did. Okay, that seems to be okay. It's all fine. So up to the last one, who is Tony. So we've gotten the average of Tom all the way to the average of Tony. I can undo, and I can start again by getting the average. Of course, equal sign, then average. You double click on the average. Then after double clicking on the average, you can type manually like B10, you can see it's highlighted, comma, C10, comma, but that is a long way. If you want to move faster, you just click on them. So 65, comma on the keyboard, 84, comma, 70, comma. Remember, if you want to jump one, you can always jump. Assuming that you never wanted the one for auditing, you can always jump and you click on the last one. So this one is now excluded in your average for that particular period, and you can see the average has reduced. So there's also another way, of course, average in range. So again, average, and you just select average in range. You select up to where you want, up to 76, then shift and you close the bracket. So that is average in range. Then you enter to get 73.5, from which you can be able to drag down your formula all the way to what you want, up to Tony, and you'll get all your averages for that particular student. You can also get average here, if you so wish, average and equal sign, or let us use now the other aspects. You can go to the formula place, AutoSum, If you see average, you click on average. There's average here, but this one will pick everything. You can see up to the next place where there's nothing. So this one majorly picks everything, but you can be able to highlight up to where you want, that is up to 20, and it will give you everything that you want. If you enter, of course the average is 66.60. You can undo, and again in the formulas you can use the insert function. You click on insert function. What do you want? You want average. Like that. So go, and you will see average highlighted here. Just click on it. Okay. Then you confirm whether B17 to B19 is what you want. B17 is just 15 subtraction, then B19 is just this one. So it's wrong. It means you can deduct, or you can do away with it and select whatever you want to get the average of. So you just select, you can see it is moving all the way to 20, and your average is set. So the average is set. Once you have done the correct thing, you click on OK, and you can see the answer is still 66.6. So whichever approach you use, of course the average is still going to be the same as in any other case. Average, you can see the answer is still 66.6. So you then drag across all the way to MA, so that you can have your average up to MA. So that is the average of those particular items. Having done the average, the next thing is maximum. Now we want to do maximum. What is the maximum? Maximum is the same as highest. So we are looking for the highest value in our set of data under financial accounting. So equal sign, then max. So you look for the function of max. This one returns the largest value in a set of values, and it ignores values and logical values and texts. Of course, this one is max. Then which one is the highest value? The highest value up to there. Then you close the bracket. This one gives you 88. So you can see in this set of data up to here, 88 is the highest value which has been returned by this. So if you copy across, it also gives you the other highest values in, like in this case is 84. In this case you can see it's 70 is the highest value here. In this case the highest value can clearly be seen to be 76, of course. So that is highest value using max. What about lowest value? How do you get the lowest value? Of course, when using the lowest value or getting the lowest value, you use mean. So we are going to use mean to be able to get the lowest value. And again, you highlight all the way to this one, and the lowest value there is that one. So the lowest value is 50. The formula is saying that it's 50. Let us see. The lowest value, indeed, 50. Here there is nothing, so it cannot count that. So 50 is the lowest value. There are two 50s, so it will just pick any. What about these other cases? You can drag across and get your lowest value. Again, here they are saying it's 50. Let us confirm. The lowest value is indeed 50 from this set of data. It's 50. What about 34 here? Is the lowest value 34? Indeed, yes. The lowest value is 34 from this set of data. Even here, of course, the lowest value is 24 from this set of data. It is 24. So that is the lowest. If you want to get the lowest value using minimum. Now we want to move to median. How do you get the middle value? Middle value, of course, we'll be using median. Equal sign, then we do median. So you double click on the median, and you can be able to get the lowest value in that set of data, median. And that is median. Is it the median? Of course, when getting the median, Excel arranges from the lowest to the largest and then accesses the median value. So if you arrange these items from the lowest to the largest, the median value will be 65. So let us copy across and see which is the median value in the other cases. You can see the median value in these other cases here. So that is median, which helps us to get the middle value or the midpoint. So after the median value, we can also be able to get mode. Mode simply refers to the most occurring. So most occurring, that is mod. Most occurring. So let us see, how do you get the most occurring in mod? So you can see mod, the function is available for this one returns the most frequent occurring or repetitive value in any array or range of data. So this one returns the most occurring. So again, we want to select here and get the most occurring in a set of data. And the most occurring that set of data is 50. Let us see if 50 is most occurring from here to here. Yes, 50 occurs twice. So 50 is the most occurring. If you copy across, you can see that it gives you 50 again here. And indeed, 50 is the most occurring, 50 and 50. But here, the answer is not available. That means there is no most occurring. So there is no most occurring here. There is no figure that is repeating itself in this set of data. So there is no most occurring. Even here, there is no figure that appears more than once. So there is no most occurring in this set of data. So that's why the answer here is not available. And indeed, that is the that is the correct answer, not available. After that, you move to another formula. After most occurring, which is mod, we can be able to get the standard deviation. Standard deviation. Of course, standard deviation is equal sign, then STDEV. That is the formula that you use for standard deviation. What is standard deviation? You can see it says estimates the standard deviation based on the sample. It ignores the logical values and text in the sample. So that we want to get the standard deviation of this set of data from here moving the way to this place. Then you close the bracket and this will give you a B10 to B15. If you enter, it returns the standard deviation as what you can see there. So that is the standard deviation. If you copy across, it gives you the other standard deviations from the other set of data there. So those are the other statistical formulas, basic of course for beginners, that you can be able to use in your work. You can be able to use to manage your work, either if you are a student or if you are working somewhere. These are the functions that are usually used when doing a lot of statistical and also mathematical tasks. There's an Excel file that is attached below the video description, which will use for your assignment. So make sure that you go through it and redo almost everything that you've done, almost everything that we've gone through in this particular lesson. Thank you, and see you in our next lesson.
Hello learner, welcome to Manifested e-learning forum. My name is Emlyn Gwiri. I'll be taking you through equity investment analysis, and what we'll be looking at today is technical analysis. And what specifically we look at under technical analysis, The specifics we will be looking at today include, we will start by looking at introduction, where I will be able to briefly explain the mechanics behind technical analysis. Then after the introduction, we'll look at the technical analysis principles. What principles guide technical analysis? Moving on, we will move on and look at the logic behind technical analysis. Then once we've looked at that, we will move ahead and look at the types of charts used in technical analysis. So what types of charts? Specifically, we will look at the following charts. We will start by looking at the point and figure chart. point and figure chart there. Then we will look at the line chart there. We'll move ahead and look at the bar chart as well. And then we will finalize by looking at the Japanese candlesticks. Japanese candlesticks there. Then once we've looked at these types of charts, we will move ahead and look at the door theory. Then we will be able to conclude this first lecture under technical analysis. Now, we start off by looking at the introduction to technical analysis. Why is the introduction important? The introduction will form the sound basis as to why we are conducting or understanding technical analysis. Why are we learning technical analysis? The introduction will try and create that or arouse that interest for you, the learner. Now, what I can be able to explain under the introduction goes like so. Technical analysis tries to cover up where fundamental analysis left off. Fundamental analysis looks at the identification of the intrinsic value of a security or an asset. That is what we have been doing by looking at the free cash flow method. We've been looking at the free cash flow method. We have mentioned about the dividend discount model. We've also looked at the price multiples. We've looked at the residual income. Using those models tries to identify the intrinsic value, the true and fair value of a security or an asset. So that once we've identified the intrinsic value, we are able to compare it with the current market price there, such that if we have the current market price, I can put that initials like that, is greater than the intrinsic value, then you are saying that the security or the asset is overvalued. So, if the current market price is less than the intrinsic, it is the opposite of that. We are saying it is undervalued. Current market price is equals to the intrinsic, it is correctly valued, like that. That is what we have been doing by trying to look at those models that govern fundamental analysis. However, what fundamental analysis doesn't do is to try and explain the short-term price movements. What am I saying? These short-term price movements can be able to dictate whether there is going to be an uptrend or a downtrend, like that, which we will be able to try and demystify under technical analysis. What technical analysis does, technical analysis tries to step in and tries to identify cyclical patterns in the price movements of securities or assets there. We're trying to identify trends or trend movements. That is what technical analysis does, and it tries to fit in, especially more so in this short-term period, trying to identify which securities to purchase during the short term there. Probably you might have experienced this when going into an investment bank or a stock brokerage firm. You would want to purchase securities for the short term. Fundamental analysis cannot be able to assist the analyst to make a decision and trying to identify the securities to purchase. That is where now technical analysis comes in. And we will be shortly looking at the technical analysis principles so that we can be able to reinforce our understanding of this topic. So we can be able to mention something right here. You can say technical analysis tries to identify or assist the analyst stroke investor in decision making as to which securities or assets they should purchase. They should purchase or sell. Now I'll explain the concept, the mechanics behind fundamental analysis and why now technical analysis tries to fit in the shoes of fundamental analysis. Fundamental analysis only tries to identify an assets stroke securities intrinsic value. And we had explained in the topic under return concept what the intrinsic value is. I'll just recap on what we looked at. The intrinsic value is the true and fair value of an asset. What an analyst believes the value of the security should be based on the 4 valuation models we had looked at. The 4 valuation models include, I'll reiterate again, the free cash flow, the dividend discount model, the price multiples, and the residual income. We are trying to identify the intrinsic value, what the analyst or the investor believes the value of the asset should be. And you compare that with what the Securities Exchange provides as far as the pricing of the security is concerned. So the current market price, which that one that is issued by the Securities Exchange, is if it's greater than the intrinsic value, the one that you've computed, then we are saying that the security is over or undervalued. So we are saying that the fundamental analysis only tries to identify an asset or security's intrinsic value and compare that value with the current market price. The decisions made under this approach is long-term in nature. It's long-term in nature. So when trying to identify using fundamental analysis, you're trying to identify after some period of time, you expect the share price to either be undervalued or overvalued there. Technical analysis, on the other hand, tries to identify securities stroke assets that should be purchased or sold, in the short term. Because you're saying that short-term price movements tend to also impact or create longer-term price movements over a period of time. there. So that is the brief introduction that I have under the introduction to technical analysis. We are saying that technical analysis may play a very critical part, especially when trying to identify small short-term movements or movements within the short term, which is say within 1 to 2 years there. So now moving on from the introduction right here, we will be able to move on and look at the technical analysis principles. What principles guide technical analysis? So we say principles of technical analysis. There. Now, having looked at and understood what the introduction or the mechanics behind fundamental analysis and technical analysis, the first principle states like so, that prices are determined. Number one, we can say prices are determined by forces of demand and supply, by forces of demand and supply. So we are saying that the demand for securities, if we have that demand curve here, so we have price and over here quantity like that, the forces of demand and supply. The demand curve is this one. I recall my economics, I remember the demand curve would go like that, and the supply curve would increase. You'd want to supply more to the market if the prices are increasing and like that. So that is the demand curve, demand versus supply curve there like that, and that is the equilibrium price. So we're saying that technical analysis is primarily driven by the forces of demand and supply. How many individuals who are demanding the security or the asset versus how many individuals are supplying the asset to the market. So there must be something to do with an equilibrium price, the price that is acceptable to both the buyers and the sellers. Number two, the second principle states as follows, that the demand and supply forces, the demand and supply forces, talk about that demand and supply curve there, are influenced by fundamental factors. Forces are influenced by fundamental and psychological factors. Fundamental and psychological factors. Psychological factors. There. We are saying the fundamental factors uses the information that is provided in the financial statements for companies. So the fundamental factors, I've already explained what fundamental analysis only tries to do, tries to identify an asset's intrinsic value there. And psychological factors are the belief that any investor has for themselves, that I believe, for example, that KCB within the short period, within the short run, will be able to increase by say 50% or 70% like that. That is what you're saying is the individual factors that affect or that influence or support rather technical analysis. The third one, as follows, is that the fundamental factors can be psychological, can be quantified. We talk about the fundamental factors can be quantified, and the psychological factors cannot be quantified. So we say that the fundamental factors be quantified, can be quantified. Whereas the psychological cannot. So the fundamental factors, we're talking about trying to identify the intrinsic value, where we use numbers or figures. We can be able to at least identify that this, you're comparing the current market price versus the intrinsic value there. So at least that one can be quantified and like that, and a decision can be made using that. we are saying that psychological factors cannot be quantified, because you cannot be able to identify individuals' perceptions about a particular stock, or neither can you also be able to quantify say the behavioral biases, because we are saying that behavioral biases can influence the market trends, either moving up or moving down, like so. Then we can also say that the combined effect of the fundamental factors and the technical factors is reflected in security prices. So I can come on this side over here, say that the combined effect you can say that number 4, the combined effect of fundamental factors and technical factors what can we say? We can say that it is reflected in the price movements of securities or assets like that. That is the 4th principle that guides technical analysis. We can look at the 5th one there, and we say that past price movements assist in the prediction of future price movements or trends there. So those are the 5 principles that guide technical analysis. The first one, prices are determined by forces of demand and supply. The demand and supply forces are influenced by both fundamental and psychological factors. Then I've said that the fundamental factors can be quantified, whereas the psychological factors cannot be quantified. The 4th one here is the combined effect of both fundamental factors and technical factors is reflected in the price movements of securities or assets there. So these technical factors here and fundamental factors work in unison like that. Then we are saying that the past price movements assist in prediction of future price movements or trends. So we are saying the use of graphs and charts can be able to dictate or provide some bearing as to which direction the share price will move. Is it either going to be 1, 2, or 3 right there? So that is what we're saying. The analysis of past price movements like that can be able to dictate the future price movements in at least the short term. There. Now, having looked at the technical analysis principles that there, let's look at the logic behind the technical analysis there. Logic behind technical analysis there. Now, the best way to describe the logic behind technical analysis is to use a graph. A graph of price against time is the best example that we can be able to use to try and understand that concept, the concept of technical analysis. So we are saying this is the price there, and this is time there. So we have the old equilibrium price there. We have it going down like that, and then we have like that. So we can be able to say this is the old equilibrium price, because you are plotting a price against time like that. Then this is the new equilibrium price there. This part right here is when the information is being released into the market. So when the information has been released to the market, investors decide or that they're not going to take up the new security, or the company's mechanics or the specifics dictate that it should be able to go down there, and less demand for that security will reduce the price of that security. So we say here is release of new information. This is just a hypothetical example that I'm explaining. It could be also the other way around. So we could have like that, a graph up to there, then it goes like that, and then we can be able to put it something like that. So we say this is the old equilibrium price is much lower, then we can be able to have the new equilibrium price being much higher as compared to that. But this is just a simple explanation that can be able to guide the logic behind technical analysis. So that is what we have there. Now, having looked at the logic behind technical analysis there, we can be able to look at the types of charts and used under technical analysis. So we move on to look at the types of charts and used in technical analysis there. I hope this has actually provided some guidance. The logic behind technical analysis is simple. You just need to plot a graph of price against time, and you understand the impact of release of new information. Once information has been released to the market, then that creates or arouses some interest or disinterest. Meaning that in this case over here is a disinterest. This first graph that I do over here. So this is the old equilibrium price. The price was much higher over here. Then the release of new information, possibly negative information, reduced the amount of demand for that security or asset, and hence now the new equilibrium price is much lower than the old equilibrium price right there. However, in this dotted line which I've drawn moving up like that, this part over here indicates the old equilibrium price, which was much lower. The release of new information within that part over here aroused interest or aroused some form of demand for that security, so that you can be able to see over here that the new equilibrium price is much higher than this dotted line which began over here. So the logic behind technical analysis is just driven by forces of demand and supply. That is what I can be able to explain under the logic behind technical analysis. Now, moving on, let's look at the types of charts used in technical analysis right there. So I can come on this side here. Look at the types of charts. So types of charts used in technical analysis. Now the first type of chart that we are going to look at is point and figure chart, or rather let me start first of all by looking at the line chart. Yes, let me just start right here. I'll be able to explain all of them anyway. So the line chart. Now a line chart is a simple plot of price against time. Now this is how I can be able to demonstrate a line chart. Now we are saying here we have price, like that, price against time, like that. And as time goes by, the forces of demand and supply changes the price of the security or the asset. So you can begin there, it moves there like that, it moves down like that, moves as it moves up like that. So we are saying this is a line chart there, indicating this as time is moving at this part over here. You can see is different from this part, it's different from here, and so on and so forth, like that. That is what you're saying is a line chart. You just plot the prices against the time, or as time moves on, you can be able to plot the security and price pattern. So this is a line chart there. Now we look at what a bar chart is. A bar chart right there. So a bar chart is a chart that is drawn like so. You can draw it right here. That. Then we can say that this is just the plot of price still against time, like that. But now in this instance, what will happen is that we are going to plot now the starting price, the opening price, and the closing prices, like that. Here is the midpoint there. Then as we move on like that, we plot like that, a bar chart like that, and so on and so forth like that. So you can be able to clearly see that this is an uptrend, or the trend is moving in that direction. As well, in the line chart, you can also see this an uptrend moving in that direction. However, if it's moving down like this, say from over here, we can be able to decide maybe it goes down like that and moves down like that, moves down like that, and this is now a downtrend that is moving like that. That is what we can say is a bar chart. So I can indicate over here, just over here, number 2, bar chart. That. Now, having looked at those two, let's look at now the point and figure chart. The point and figure chart right there. Under the point and figure chart, a plot of only prices is provided, but now in a very different and unique way. The plot against price alone is the one that is used. So we are saying this is what we have, like that, and then we don't have an x-axis there. We only have the y-axis here. So here you have prices of securities like that, and you're saying if you have a rising trend, you can be able to indicate that is for a specific time period, say within 1 hour, and the prices have actually increased up to that level there. So this is, say for example, 200, 201, 202, 205, 207, 210, and so on and so forth as we increase like that. However, after this 1 hour, you can be able to find that now the prices have begun to reduce. So you find that this is what happens. We can indicate the reduction using circles like that. And if there is an increase in prices as well, we can be able to continue and put X's like that. And if it's a downtrend, then we can be able to indicate like so, and so on and so forth like that. That is what you're saying is a point and figure chart. We can also plot a point and figure chart using the actual prices. So we are saying that over here, if you can be able to have, say, a parallel diagram right just besides this point and figure chart right here, that, and indicate now the prices over here. So we indicate, instead of having the x-axis indicating the prices like that, we put it now on the graph itself. So we have 200, 201, 202, 205, 201, 210, 210, and so on and so forth like that. Then you find over here now a reduction, 205, 202, 201, 200, 199, 198, 97, and so forth like that. Then we have now 201, 202, 205, 207, 209, and so on and so forth like that. So you can see there's a slight difference between this point and figure chart and this one, but you can be able to induce some kind of or infer some kind of decision over here. You can see this is the congestion area or the concentration area right above this part over here. That's what you're seeing is the congestion area like that. Now, having looked at these three, we can say this is the third one over here, point and figure chart there. Then finally, we can look at the Japanese candlesticks over here. Why these are important is because technical analysts believe in the use of graphs and charts to try and identify price trends that can be able to assist them in making decisions as to which securities to purchase or assets to purchase. Number 4, we're talking about Japanese candlesticks. That Japanese candlesticks. Now, what you need to understand under Japanese candlesticks is, first of all, the look of the candlestick itself. A candle looks somewhat like that. Here, before I put this wick over here, I can be able to have that body indicating over here opening price, closing price. We can have like that, or we can be able to have another Japanese candlestick like this, where we have the closing price and opening price, like that. So you can see this is the opposite of this one. Here you have the higher closing price, and here you have a lower opening price, like that. Now, putting that understanding onto a graph, this is what we come up with. We have a graph like so. And put it somewhat like that. Then we can be able to identify now, we can draw now that candlestick over here with that and that. What I didn't explain on these graphs is that here you can be able to have the wick over here, you have the highest price, highest price, and here you have the lowest price, like that. So you will have candlesticks like this moving in this direction, that provide some guidance to the analyst or the investor that this is a bullish trend. A bullish trend means that it is moving in an upward direction, like that, with even highest price happening, higher opening prices or even higher closing prices. Remember, if you're looking at it from this perspective over here, you'll have the opening price being over here, the closing price being much lower. But now, this scenario is usually very typical when you're having a bullish trend, where you have a closing price moving higher and higher and higher. So here you have the closing price, closing price, closing price, closing price, and so on and so forth, like that. But now when there's a bearish trend over here is where you'll be able to see that the closing price will tend to be much lower than the opening prices, like that. So that should be understood from the Japanese candlesticks perspective. So here we have the price, here we have time moving in that direction. These Japanese candlesticks are the most commonly used by technicians because they indicate the closing prices and the opening prices in a probably maybe systematic fashion compared to the other charts that we've actually looked at there. Now, having looked at the 4 types of technical technical analysis charts right here, now we move on to look at the Dow theory. Dow theory. Charles H. Dow was an editor of the Wall Street Journal between 1900 and 1902. Being an editor, he was the founder of the Dow Jones Industrial Average and the Dow Jones Transportation Average there. Those are indicators that assist technicians or technical analysts to identify price movements. What we need to understand under the Doe theory is that the historical price movements like so, these historical price movements like that can be able to provide an indication for the price trend that is going to occur in the future there. Now we look at the principles backing the Doe theory. Principles of the Doe theory. Now, Charles Doe said that the price movements of securities move in three directions or three movements: the primary trends, the secondary trends, and the minor movements. Take this example. If you have, say, a bucket full of water like that, this bucket and it's full completely, you hit it on the side like that, you will be able to see the ripples moving towards the center like that. Those are representative of the minor movements. You hit it slowly, or if you hit maybe say a cooking pot like that which is full of water, you'll be able to see ripples moving like that. That represents the minor movements. That. Now, the primary movements and the secondary movements, the primary movements are synonymous to what we can be able to say tides, and the secondary movements are similar to waves. Waves are smaller than tides, and the minor movements are the smallest like that. Putting it all together, before I actually come to the principles of the Doe theory, what I can say is this: if you have a price movement moving in that direction like that, this would be able to now indicate that's the actual price movement. So you will find the price movements, or you're saying that you have the primary movements indicative of that movements like that. I should have probably used maybe a fainter kind of marker like that. So this is the security price that is moving in that direction. So we can be able to have like that the price movements moving in that direction. That is what we're saying is the secondary and the primary movements there. The secondary movements are usually smaller like that guide the direction movement of the price like that. The minor movements are indicative of very small movements of prices in that direction, similar direction of those two other trends like that. That is what we're saying is the Doe theory. The Doe theory has got three postulates, and the postulates or the principles are as follows. Number one, we can say like this: that all information that is guiding the Doe theory there is reflected in the averages of market prices. So all information is reflected in the averages of prices, of market prices. And those averages, what can we say? We can say that those averages reflect market movements. Those averages reflect market movements. That is the first postulate like that. I shouldn't have put it in form of bullet. I should have put it like that. That is the first principle. The second principle can come on this side right over here. You can say that the averages exhibit three movements. Averages exhibit number two, the averages exhibit three trends, full colon: primary trend, which is representative of tides. Secondary trend, this is trend, it represents say waves, and the minor trend, which represent ripples. That. Number 3, all the 3 trends move simultaneously. All the 3 trends move simultaneously. So those are the principles that guide the door theory. This comes to the end of our first lecture of technical analysis. We hope that you can be able to join us in our next lecture, where we will continue with the same topic. Thank you. God bless you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tomboya Street, Pioneer House, 3rd floor, opposite Fire Station.
Hello learner, welcome to Manifested e-learning forum. My name is Emlyn Ngwiri. I'll be taking you through equity investment analysis, and the topic that we're looking at is technical analysis. In today's lesson, we are going to look at the following. So we are going to look at, the first thing we're going to look at is primary trend. Then we will move on and look at secondary trend. Like that. Then we will move on to minor movements, like that. And these are the principles that underlay the door theory: primary trend, secondary trend, and minor movements. Then we will look at the interpretation of trend lines. Interpretation of trend lines, like that. Now here specifically we'll look at uptrend, that. Then we will look at the downtrend and no trend. Downtrend, trend, and no trend, like that. Then we will move ahead and look at the prediction of the market using the door theory. Prediction of the market using door theory. That. And then we move ahead, we'll be looking specifically at the Dow Jones Industrial Average and the Dow Jones Transportation Average there. Moving on, we will look at the support and resistance level. Support and resistance levels, like that, and try to explain the reasoning behind the support and resistance levels. Then we move ahead and look at chart patterns. Yeah. Then we'll move ahead and also look at the reversal patterns. Reversal patterns. And finally, we will look at the trend lines. Trend lines, like that. Now, this is what we will look at today. And we start off by looking at the primary trends. Primary trends. Yeah. Now, the primary trends, as explained in lesson 1, we had said that the Dow Jones, the Dow theory is governed by 3 trends: the primary trend, the secondary trend, and the minor movements. And I will be able to demonstrate the primary trend as follows. So we will be able to draw how the primary trend looks like on, and we'll try and superimpose the primary trend, secondary trend, and the minor movements on one graph like that. So here we have increasing like that, the prices. Here we have time like that. So if we have the primary movements move in form of trade. So this is the security price that is moving like so. For example, it's moving like that upward direction, bullish trend. This is now moving up. Bullish means that it's moving up. Bearish means that it's moving down like that. So trying to explain the primary trend, it is in form of waves, rather tides like that. So that is an indication of a bullish trend based on the primary trend. How different is that bullish trend from the primary trend from the secondary trend? Now the secondary trend is a movement in smaller patterns like that. So it just follows the primary trend, but now in smaller, what we can be able to call them as smaller waves like that. Superimposed on this, we can be able to explain the minor movements. So the minor movements now follow the trend, the general trend, but now in smaller, what you can say, smaller movements. That. So you're moving like that. So the primary trend is the bigger wave that moves like that. I can be able to demonstrate right just below this. This is the main graph over here that we're looking at. Wait, you have superimposing, and you have the primary, secondary, and tertiary trends superimposed on each other. But now, trying to explain the primary trend, this is still prices like that. Here is time like that. So we can be able to just explain now the primary trend, because that is the major topic that we've actually talked about over here. So if the security price is moving like that, so you can say that this represents primary trends. You can say this is A, primary trends like that. That is what we have looked at there. B, say this is A, now this is B. Primary, secondary trends. So the secondary trends move in smaller prices, time. That. So if you have now, we can be able to use bearish trend like that. This is bearish trend like that. So we can be able to say now they're moving in small waves like that. This is what we're saying is a secondary trend. It's much smaller as compared to this one. You can see this one is much bigger there. This one is much smaller there. C, so you can say you can use this B, secondary trend line, but here is primary trend line. So you can be able to see it like that, and this is the primary trends like that. Now we can be able to now draw finally the minor movements. Prices, you can put this right here. We have prices. Here we have time. That. So we can be able to say, if we don't have a trend, we can give another description over here. If the prices are moving somewhat like that, over here we can have very small movements like that, which are indicative of a minor movement. So here we have C, minor movements over here, and we have minor movement line, see minor movement line like that. Now, having looked at the primary trend, now here we have the primary trend. This is the major line, here is the primary trend like that, and we are saying that this is now the big tide over here. This is the wave, and this is the minor movement. We can move on to interpretation of the trend line. So you've looked at the primary trend, the secondary trend, and the minor movements there. Now we move on to look at the interpretation of trend lines there. So let's look at that very quickly. We have interpretation of trend lines. Interpretation of trend lines. Interpretation of trend lines. Now here, more specifically, we had said an uptrend, a downtrend, and a no trend over here. And so we are saying in an uptrend, we can show it like this. So if we have prices moving like that, this is prices, this is time here, we can be able to draw a line like that. As well, we can be able to also draw a line like that, and this is an uptrend, bullish trend like that. Now this is an uptrend, so once you see security prices moving in that direction, generally of course you don't expect them to move like this. In practice you might expect them to move somewhat like that, not very straightforward lines like that. This should be indicative of an uptrend like that. However, so we can say this is an uptrend, A here, uptrend like that, B we have downtrend, downtrend like that, and we draw a downtrend like so. This is prices, this is time. So downtrend moves now the opposite of, and then we can be able to probably draw what we can call a channel like that. So that one not very perfect. It's good to be perfect sometimes, not all the time, but you can try that. So that is a downtrend, what we can call bearish trend there. Now a no trend is where the market moves in a fashion that does not indicate, or in a way that does not provide any indication of a trend, and I will demonstrate that shortly. Where we have like so, we can use this. Make sure at least we are accurate, almost accurate. Time, that. This is prices, that. So we are saying if trend moves like that, then we don't have any movement in any particular direction. It's neither is it moving in a bullish trend, neither is it moving in a bearish trend over here. So you can say here, C, no trend, like that. Now, having looked at the interpretation of trend lines there, we move on and look at the prediction of the market using the Dow theory. We can look at the Dow Jones Industrial Average and the Dow Jones Transportation Average right here. So this, we've actually done the uptrend, downtrend, and no trend there. So moving on, this Dow Jones Industrial Average, Dow Jones Transportation Average provide an indication of when to buy a security and when to sell a security. So the best way to demonstrate this prediction of the market is to use a graph. So I can use this part right here. Draw it like that. Not be very perfect, but at least I'm trying my best. Prices. Yeah. And here we have time moving like that. Probably that line may not be the best. Let me just redraw it again. Trying to consider that. Yeah, I think that's better. This is time. Yeah. Now, the Dow Jones Industrial Average is usually much higher. It has got generally higher prices as compared to the Dow Jones Transportation Average. Now, we can be able to just draw roughly how the Dow Jones, it's just like an indicator of when to buy securities and when to sell securities like that. So we can say Dow Jones Industrial Average Index. Now we can have, probably can have something like, this is when to buy and when to sell. Probably it may not be the best. I can just rub somewhere here and maybe change it a bit. Like that. That. Yes, let's put it like that. Draw lines like that. Also like that. So if we can be able to just draw the Dow Jones Transportation Average right here, like so. So this should be somewhat like, should have been actually at the bottom